Thank you for coming back and sharing some time with me. Real quick introduction. So what I'm doing here, I'm going through the chapters of my first book, one at a time, the Art and Science of Technical Analysis, and updating you on how my thinking has changed, where I think in some cases maybe the markets have changed a little bit, but also taking points where I have seen people struggle with the material or where things might have been a little bit unclear. So it's a chance to clarify, it's a chance to expand, and in some cases, really to dig in deeper. Our topic today is Chapter 3, Trends. But before we do that, let's think a little bit about complexity, because this is one of the conflicts with learning technical analysis or learning to trade. Ultimately, the process of trading really has to be very simple, and I use the phrase unencumbered here, use the word unencumbered. So, this means that, yes, you might do analysis before a trade, and certain kinds of trading can be more analytical. For instance, a lot of derivatives, you might have a lot of math that goes into figuring out whether to make a trade or not, but it still comes down to there's some point where you're going to enter a trade and there's some point you're going to exit a trade. And if you are successful, you're going to do this not hundreds of times, but thousands and maybe tens of thousands of times over the course of a trading career. So each one of those trades has to be a relatively simple act, which means that there has to be simplicity at the core of this, right? But I've committed to doing 12 sessions that are going to be, I don't know, somewhere 30, 40 hours. How does this possibly make sense? And I want to give you something to think about today. This is a 2007 book, The Art of Learning, which I would very, very much recommend anybody read. Whatever you are interested in doing, even if it's just being good at your job, I think there are a lot of nuggets in that book, and Josh lays out a framework for being really good at anything. And this is one of his concepts, it's not mine, wish it was, but he talks about form to leave form, and that's in the context of Tai Chi, or because he has excelled in both chess and Tai Chi, or sometimes he will say numbers to leave numbers. But just to kind of read some things here, this is a process in which technical information is integrated into what feels like natural intelligence. And continuing this quote, what he really thinks he has done here, and what I think that I've been able to do in my work, is that this is really about interconnectedness. I'll let you read the slide. But the key is that you have all of these pieces of knowledge. And when you're a beginner, this is why, we talk a lot of times about the beginner feels very early on that you know a lot. There's, particularly in trading, there's many times an arrogance that comes from new traders because you accumulate a lot of knowledge very quickly, and you realize that each of these little pieces is pretty simple, and you can study trading for a few weeks and feel like you know a lot. And then what happens, of course, well, we all know when you actually trade, you kind of smack into the wall. And so then, the typical emotional curve, the new trader thinks she knows everything, and then a few weeks later, thinks she knows nothing at all and is absolutely hopeless. And of course, neither of those things is true. But you don't know as much as you think you do at the beginning, and it's absolutely not hopeless. But the key is to connect all of these pieces of knowledge. And that takes a lot of time. That's part of what we're doing here. I have, for instance, today we're going to be talking about trends. And of course, when we talk about trends, one of the most important things to understand is how trends end. Because if you think about it, if you could have a trading superpower, a pretty good one would be to know at any point in time, is this the end of the trend or not, right? If you would literally never have a losing trade. It's impossible. But that's what you might wish for. However, today in talking about trends, we're not really going to talk about the end of trends that much. We're going to save that for a future session. So what I have done here in these presentations and in the book and all of my teaching and writing is to steal from another author. Imagine that you're watching a bird circle around this big green circle. You can imagine, like, drone footage of this bird. And the bird goes around the big green circle again and then continues around. And you think, oh, wait, I've seen this before. Okay, this is the same thing I've seen before. But as the bird is circling, it's also ascending. So what you actually realize is you're looking at a tree. And as the bird goes around and circles higher and higher, you're seeing the thing from different angles, and eventually you have a picture of the whole. That's a pretty good model for how I hope I can teach. It's a pretty good model for what we're doing here. That's why you're going to see some elements of repetition built in. And if you leave today's session thinking, oh, there's still things about trend that I wish I knew, we might hit on those in one of the future things. But just to wrap up this idea about numbers to leave numbers, form to leave form. So I think the way to do this is to go as deeply into the nuance as you can. And I'm perfectly aware there are a lot of people out there who will tell you that technical analysis is simple. And I'm pretty sure that if we were sitting in a bar and I had two little bar napkins, I could probably draw the most important things you need to know on those two napkins. I could, on one hand, think on those two little bar napkins, I'm giving you all the knowledge you need to be a trader. But you will not be able to do anything with it until you're able to connect all of those pieces. So if you are a developing trader, we're all developing traders, particularly if you're a struggling trader, if you're a beginning trader, this is the roadmap. You're going to need to go very, very deeply into lots of different pieces of knowledge and lots of different areas of trading, many different areas of trading. And you will find that some of these maybe don't end up being very important in themselves, but it won't start to come together for you until you can draw all of these connections. And I think, go read that book. That's a great book. I think Josh has a lot of ideas about peak performance and even how physical conditioning relates to peak performance in various disciplines. Absolutely worth reading. But keep that idea. Come back maybe over the next week. Push yourself to think about form to leave form and numbers to leave numbers. So how do you do it? Well, you can't just listen to me. You can't sit here for a few hours today and say, Adam, pour this knowledge into my head, thank you, and then you go away and you know this thing. You have to challenge yourself to generate the answers. It's very different. For those of you who have studied a language, it's one thing to think, I know how to conjugate this verb. It's quite another to force yourself to do it, or vocabulary, whatever, right? Or, whatever the discipline is, you need to create ways that will force you to be able to produce the answer. I also would spend a lot of time combining, going deeply into an area, as I just said, but also thinking about how things relate. Thinking about, for instance, we're going to talk about trends today, and we're not going to talk a lot about what happens when the market opens every day. That opening event where all of these orders are imbalanced and everybody kind of scrambles to figure out what's going on. That's a pretty big thing in the market. So maybe you think about how that relates, or maybe next session when we talk about ranges, which are kind of the opposite of trends, maybe you spend some time thinking about how trends and ranges relate. And some of these connections will not be important. Some of these things might be silly, but some of these things will force you. But by forcing yourself to think about these things, you are going to find valuable connections, and you're going to change your brain in some pretty good ways. And what it will hopefully feel like you do is you'll learn all of this knowledge, and then it will just kind of become this working backdrop for you. Just to some extent, you forget a lot of what you've learned, and that's deliberate. So outline what we're going to do today. We're going to look at what is a trend. We're going to look at some problems with quantitative measures of trends. We're going to look at a very detailed level how trends begin, how trends continue, and a little bit of how trends end, because it's impossible to talk about continuation without ending. And we're going to look at all of this points as very directly, very immediately to some basic trading structures. So let's get started. So what is a trend? Well, if you look at technical analysis books, this is very interesting, because a trend is, everybody acknowledges, it's one of the most important aspects of markets. Now, I am aware there's some academic work that challenges, says, maybe markets don't even trend, but there's a certain degree of contrarianism, is that a word, or sensationalism. It's good for an academic to be able to say, hey, here's something maybe nobody's ever thought about. And of course, if you make that your goal to find things that somebody's never thought about, you're going to come up with some pretty silly things. And I think, frankly, the argument that markets do not trend is indefensible. So it's out there, and those of you who come from an academic background, you might be saying, wait, what about? So yeah, I know about it. I'm dismissing it because it's senseless. But the really interesting thing is, how do we define a trend? How do we say if a market is in a trend or not in a trend? Thinking about what is a trend? Well, it's a market moving from one price to another. And you can imagine this happens, and it's impossible to consume any news without seeing people push these different narratives around that explain why crude oil is going to be scarce, why Europe is going to freeze because there's no natural gas over the winter, why the stock is going to take over the world, or why the stock is going to go out of business. And some of these things are true, some of these things turn out not to be true, but there's always information coming into the market that the market then looks at the information and says, does this make sense? And does this thing, whatever thing we're talking about, need to move to another price? Sometimes that happens very quickly. Sometimes it's a slow adjustment. One of the other ways to think about a trend, and this is important, so pay attention if you've been zoning out, is a failure of liquidity. So what I mean by that, if you look at a market that's just kind of bouncing around, you have people willing to buy and sell on both sides of that market. That's why the market is bouncing around, because let's just use a round number. Let's say $100. Let's say whatever this is, it's $100. Well, as it goes up above $100, people realize that's probably too expensive. So there are people waiting to sell there. We don't care whether they're getting short or whether they have longs. They're like, it's a pretty good price, I'm going to get out. But for whatever reason, there's selling pressure there. And then the same thing happens on the downside. Once it gets to 95 or 90, people go, oh, this is really cheap. And so then the people will step in and buy. We talked about this in the Wyckoff session, right? Talking about this composite operator, just being able to think about buying and selling pressure as two groups of people, or even two people. He used the word composite man. What happens in a trend is one of those sides starts to have a lot less conviction. So as this thing goes up to $100, the people who thought it was expensive at 105, now they're not so sure. So now they don't sell. And then it goes up to 110. And now people are like, oh, maybe this is the new price. Maybe I should buy. And so now more people buy. That's actually a critical thing. We're going to come back to that in a moment. When you think about these groups of buyers and sellers in the market, what actually moves a market is somebody buying or selling. It's not somebody having an opinion. And in fact, what is most clearly the thing that will move the market is somebody changing their opinion. So what I mean is, let's say you have just three groups of people. You have sellers, you have neutral people, and you have buyers. And the sellers have sold, the buyers have already bought. Now, in reality, this is probably a continuous spectrum, but just imagine three groups of people to understand how it works. So what's going to make the market go up is when those neutral people become buyers and they buy. Or when the sellers become neutral, how do they move? They have to cover their shorts, so they have to buy. It's people moving camps, moving from moving from conviction level camps, if you will, to others, that's what actually moves a market. It is not people having a very strong opinion. So, if everybody in the world is extremely bullish on a market, that's actually a point of vulnerability. We'll come back to that in a moment. But still, okay, so this is, I think we understand in kind of a fuzzy way what a trend is, but I still haven't answered the question, how do we know if a market is trending or not? And turns out this is a difficult thing to do because getting the definition right is very, very difficult. If the definition is too specific, then we might exclude a lot of things that really should be in that definition. For instance, we could have an indicator setting, or we could have a specific pattern of trend lines. But if a definition is too broad, it doesn't tell us anything. And one of the things that kind of makes me groan every time I hear it, and you hear it a lot because it's one of the mantras of technical analysis, is that a market is always trending, and a market is either trending up, down, or sideways. It doesn't really tell you anything, right? So if you define a trend, and the sideways trend, of course, we would call it trading range, but the real question is, where exactly do you change definitions? People say things like, every move is a breakout of something, or everything happens at some level in the market. This is one of the things to watch out for in technical analysis. And I'm not criticizing other thinkers. I'm criticizing your thinking, and I'm challenging you to be more precise. A lot of time, one of the things I said for years is the best pullback in the market is the first one in a trend. That's true. It's also absolutely worthless because when do you know that? Much later in the trend. So you have to have something here that's actually going to be useful to guide our actions. Let's just take a look here at a couple markets. So one of the problems with any technical analysis book or presentation is that we can be very sneaky as authors. We can spend a lot of time going through charts and finding really, really good examples. So I didn't do that. I've deliberately not done that in today's presentation. Instead, here's the S&P futures back to the beginning of 2022, and the next chart I'll show you here is going to be crude oil, same time period. So let's look at these markets and let's define trends. Is this market trending? There are a lot of different ways we can answer this. We can say, well, in general, let's kind of go it that way, right? I just drew a random line on the chart. So, and we certainly, our ending price here is lower we're lower at the right hand than at the left hand side of the chart. And we've certainly been a lot higher. So yeah, okay, it looks like we're trending. But then I would say, well, why don't we define the trend like this? Because now, and then you see the slippery slope we're on, right? Where exactly is this down? Is this up? Is this down? Maybe. Is this down? Is this up? Is this down? Is this up? So we're looking at swings. For those of you who've done swing and pivot analysis, where we have sort of sunk into. But I would also point out here that you certainly could see a big period of sideways action. And the problem is that what you would do when a market is ranging sideways, you basically can go against a move with a high degree of reliability. If you knew the future, and you don't, that's the whole problem. If you knew the future, you could just short anywhere in here. You could just buy anywhere in here, and you would be absolutely fine. You could buy anywhere in here, and you would be fine. But our trend definition, and this is why one of the questions I want you to give you the ending point today. I want you to come away from this presentation on trends, asking yourself the question, is it even worthwhile or useful to define trend? I'm not sure the answer to that is yes, and I'll show you a couple ways to work with that. Here's just to give you some idea. This is not a carefully chosen example. And you have here, you certainly can draw all kinds of trend lines, and I'm in PowerPoint here, so I can't draw perfectly straight lines, but you can draw different lines like that. We can draw trend lines on the other side of the chart. We can draw a trend line here that's pretty clearly broken, and we can define and structure the trend like that. We also certainly can look at the market's making new lows here, right? So this seems to be some pretty definitive downtrend here. But what you also have are these significant distortions. And you have these big spikes that you don't know what to do with. You have here, some of you may remember pretty recently, we had a big over the weekend gap here in crude oil. And these are the realities of, if you step outside of nice ordered examples in books, these are the realities of what we see on price charts. We're going to come back to this, but I just wanted to show you the ugly, dirty truth. Now, before we get into like the really detailed functional things of trends here, I also want to say if you have questions, go ahead and type them in the chat box. I have Tom and Betsy and Annie here with me today. They will answer some of your questions in the chat. I will try to get to the questions that they can't get to. This is intended to be interactive. We might not get to your questions right away. If I know I've answered something later in the session, I might leave it. But if you do have questions, please feel free to ask. Feel free to use the chat box. Okay, so this is the fundamental pattern of a trend. And the idea is that a market makes a sharp move here. And in both of these examples, this is the A to B point. This is what we would call, you'll hear me use language like a momentum move. Momentum is a difficult word because it means a lot of different things to a lot of different people. But if I talk about a momentum move or an impulse move, what I mean is a sharp move that shows real conviction. We'll look at many, many examples of this in the market. And then there is naturally, because everything in the market kind of functions on reaching a bit of a short-term extreme and then moving back in the opposite direction. So what happens in a functional trend is you have this AB move, and then you have this wave against it that shows less conviction and less momentum, and that's marked here by BC. And then the expectation is that you have a move out of that. So you have the sharp conviction move to the upside, and then you have a relatively more gentle move to the downside. And the expectation is that that move is setting up another move like that initial move. This is, a lot of people have written about this. A lot of people, you can't look at a chart without seeing this. Let's go back to some of these super messy charts and just look for that. So here is, I'm just picking a random point. Here's a big move down. Then what happens? Market makes a more reluctant move up, and what happens? We have a resolution down. Now, the follow through is not always impressive. Look here. So here's an A, and here's a B. I was trying to, use some different ways to illustrate this. And then here you have the reaction move down, B to C, and then the move up to D was not super impressive, did not have a lot of conviction. What we might have expected was another move like that. We didn't quite get there. But then look what happens after this move. Here you have a little move down. Do you see it? Little move up, and then another move down. So this is always happening in markets. And we're going to look here, let's just go back to the S&P, and you can see the same thing here. Big move down, here's this pause, another move down. Now, there are times when the market kind of locks itself in a, let's say, a non-conviction move. So these sideways moves, these trading ranges, you don't typically see the same kind of action. You do sometimes, and we'll talk about that in a moment. So this is, if you just have to know one pattern in the market, this is probably the one. This is the one to, this is the one that will structure everything else. And this also leads us to a, if this is the fundamental pattern of markets, it makes sense that this should be a pattern that we can trade around. So yes, this is in fact Some people would define themselves as pullback traders, meaning that they're traders who focus on primarily catching these pullbacks. There are a lot of words for these things. The exact words don't really matter. I don't care whether you call them pullbacks or consolidations or flags. I will tend to use those pretty interchangeably, and we'll sometimes attach a direction to them. So if we're talking about a bull flag, that is a flag that we think will resolve to the upside. A bear flag is a flag that will resolve to the downside. Wedges, pennants, boxes, these are like maybe more specific geometric shapes, but it doesn't really matter. Even sometimes diamonds can be this. The idea is that you have a market that has made a move, it then pauses and will move again in that initial direction. There are two broad categories of pullbacks you need to understand. There's the simple pullback that looks like this, and then there's what we call a complex pullback or complex consolidation. Now, it's not a surprise that the complex consolidation actually includes this AB, BC, CD structure within itself. So back to the challenge of defining trends, what you might actually say is that this thing that we're looking at on the screen here is pretty clearly an uptrend, right? The market is going higher, but it did so with a complete downtrend within this. So this complex consolidation is actually a ABCD downtrend. One of the core idea driving this is that consolidations tend to resolve in the direction of the existing trend. And let's look at a few here. So this is, I think when I captured this, I just paged back a couple more pages. Look at the little pullbacks here. So let's start this move here off of the lows. When I do a lot of this work on the charts, I'm going to pause my webcam because I don't think you need to see me. I'll make the charts a little bit bigger for you. So you have this big move up off of the bottom, and then you have a little bit of a pause. This is a pullback, and then an extension to the upside. I'm just going to go through, I'm not going to go through each of these in detail, but you have, just notice all of the different shapes. So these are not carefully chosen examples for a book. This is real market stuff. Now, look here. So this, I'll draw an arrow to this one. This is quite different, right? One of the things that we expect to see is that a market makes a sharp move and then the pullback kind of looks like this before it heads higher. This looks more like this. So we had a much sharper move against. It's very important that you understand this does not mean the end of a trend. A lot of, if you just learn some basic patterns and then you have a market that does this, you might say, oh, time to get short because the trend has broken. Well, this example is a good example just because you see that doesn't happen. This is a trend pattern that is not in the book that's absolutely worth knowing about. Let me highlight a few more spots here. Look at this. So depending on, you will see this more often with Keltner channels than with Bollinger Bands. This is something that I have called a slide along the bands trend. What it is, and this is some variation of it here. So you can also, I've written some blogs on it. The idea is that the market trends without pullbacks. So here, the point of this slide is pullbacks, but I've highlighted with the red boxes 3 areas where the market makes substantial trend moves and does so without a clear pullback. This is a low volatility trend. It also is a very powerful trend because it's a trend where you can just kind of sit and see the market slide a lot further than you think. Can go much further than you would think in this low volatility consensus condition. However, what you need to be aware of is that the breaks from these, and look, let me number these 1, 2. Look what happens after each of these boxes. 3, that's supposed to be a 3 and a 4. After 2 and 3, we had a really nasty meltdown, right? This is typical after the slide along the bands trend. where, because it is a trend of consensus, it's one of those situations in the market where every piece of news you hear related to the market is probably going to be bullish. Everybody will kind of sit back and fold their arms and be, very smug about thinking, hey, this market's just going to go higher, and I know it. So what happens when that expectation is surprised? There's a panic scramble for the exits. This is not in the book. This is, there's actually not a specific slide on this today, but this is an important pattern that you will see on all time frames that you certainly should be aware of. Let's just look at let's leave that for a moment and just point out here a couple more pullbacks. So if you haven't seen these before, you're going to start seeing them everywhere. Look at this move down, which then sets up this pullback, which then has this resolution. That is if you only have one pattern to see the market. And I'm not suggesting you should have one pattern to see the market. You should really have, I think you should have a full understanding of how the market moves. But if you only had one pattern, this is probably the best place to start. So thinking still a little bit more about pullbacks, there are three things we can expect out of a pullback. And this is kind of in order of likelihood or significance. The first expectation is to hit the previous swing high or low. And that's what I've illustrated over here on the right of the screen. Once you have gotten back to this previous swing, the pullback has fulfilled its expectation. Now, that has a practical application. So if you are looking to enter, let's say you're looking to enter a pullback trade and you are very close to the previous pivot. So let's just say, for instance, that you're looking in, let me erase the lines. Let's say you're looking in this area. You're looking to buy this pullback. You really probably would have liked to have caught it down there, but you didn't. Now you're looking later. But what you're aware of is, hey, that first target is really not very far overhead. And it's entirely possible we'll take out the first target and continue to blast to the upside. But what you have to ask yourself is, do I think this is a condition where the market is likely to extend, where I can justify buying close to that? Because just remember, once you've hit that previous swing high, you've achieved the first thing you can expect out of the pullback. The second thing is a measured move objective. Measured move objective is to go back and look at this swing structure again, the pullback structure. Once you can measure this AB move, you can then extend that from the low of the pullback. So what this says is, if we're using this lettering scheme, the extension CD will be as big as AB. What do I mean by as big as? Generally, we can think of this in both price and time. So if you're looking on a chart, a useful heuristic is you can just extend the same move at the same angle. In reality, it will rarely be perfect. And being aware of the price level it's a pretty good way to set price targets. This is the second expectation. So first expectation is you just hit that previous pivot. The second expectation is you extend beyond it into a measured move. And the third expectation is for complete trend continuation. Let's just go back to the S&P chart here. So this was a pullback that achieved the third option, right? You just had ongoing trend. This was a pullback. So this is a pullback to short. So you're expecting the market to go down. This came very, very close to, and might be quite exact, to reaching that measured move objective. So what you're doing here is you're taking this, and if you're using a charting package, there's all kinds of tricks you can do. You can just draw a trend line there between those 2 points, and then just take the middle of the trend line and move the anchor here to see roughly what you can expect. And so this reached its measured move objective, and then we pointed out, here's one that really didn't get much beyond its high. Here's a pullback. This is a pullback. So if you look at this, this is a pullback that looks like a losing trade. Imagine if I had been buying anywhere in here, it got pretty ugly very quickly, right? But this pullback did in fact hit those new highs, did so that was a successful pullback trade. Not a very impressive one, but option number one here is not very impressive. Now the measured move's kind of a weird thing. Why should this work? So one of these other things that you need to be aware of is that there's a lot of like almost mystical, very weak thinking, in my opinion, about different ratios and different waves and different theories. And all of this is, well, it might be interesting. I think it's dangerous because anytime somebody tells you, here's something in the market that has cosmic significance. In doing this presentation, there's a kind of famous technical analyst who was really big on fractals. And I sat through a few of his public presentations on fractals and discovered that what he was presenting was mostly mathematical nonsense, but he believed that Mandelbrot, who we'll talk about fractals more in a moment, had discovered that stock market prices and corn futures prices had exactly the same fractal dimensions as the shore of the Mississippi River to like the thousandth decimal place or whatever. It's not true. It's nonsense. But if you believe that, here's the danger. If sometimes I think you can believe things that aren't true, and like you get through your life with no problem at all. But in trading, if you believe something like that, you're going to attach undue significance. Because if that were true, then I would say, wow, this is literally cosmic level significance. There's probably nothing more important. But then you end up pouring all of your focus and all of your energy and hanging all of your trading success on something that's not actually based on cosmic significance. So we need to be careful about that. And we need to make damn sure that this measured move objective business is not based on some kind of woo-woo like that. It's not. So all we are saying here, the reason the measured move objective works and works and works is just because it's based on volatility. Whatever, and what's volatility? So volatility is, if you ask an academic what's a volatility, they'll give you a very good answer. This is kind of a nice thing because it's actually a very deep concept, but it's easy to explain in a simple way. Volatility is just how much a market bounces around. And a volatile market will move a lot more than a non-volatile market. There are literally hundreds, thousands of ways to measure volatility, thousands of ways to predict future volatility. I did at one point, I did a research study on the number of papers written with volatility projection models. This is quite important for people trading options. And I think there were like 3,000 papers with different variations of mathematical models. Interesting thing, all of these models they have different inputs, but in all of the models, do you know what the most significant, the largest input is to measure future volatility? It's current volatility. So you measure this is a mathematically valid thing to say. The best estimate of future volatility is based on current volatility. So that's why this thing works. Now, of course, is future volatility always like past volatility? Absolutely not. Let's go back here. Look what happens in this area. So you had a market here that was relatively quiet. One way to think about volatility, it's not a particularly academic way, but is just to look at the height of the bars, the range of the bars. And you can see in my little bracket, the bars got a lot bigger in the right. The volatility increased. If you look here, these bars are a lot smaller relative to the bars around them. So volatility does move. I'm not saying that future volatility is always just like the past volatility, but it's usually a lot like the past volatility, and that's a very, very good assumption. So that's why this works, and that's why this will continue to work as long as we have financial markets that look anything like our markets today. There's also a subtle aspect of follow through to volatility. And for those of you who are into academic modeling, you might think about that. There is definitely a directionality because a lot of most of the modeling assumes diffusion process, random walk, and I think as discretionary traders, we can sometimes do a little bit better than that. Just a few examples here of how measured move works. These are, and to find these, I did look for nice examples here, but I completely eyeballed them and then I measured. I found these very, very quickly. You should be able, if you're flipping through on your screen, maybe 3 or 4 screens of charts, you should find multiple examples where a measured move pretty much worked. Now, what do I mean pretty much worked? Sometimes we'll go beyond. Sometimes you will see these really pretty exact tests. I wouldn't get so caught up in that. These outside examples here are very, very nice, but sometimes it won't be quite that exact. However, it does give you a pretty good estimate. And one of the things that we can take from it's basically a way to calibrate expectations. So if you're looking over here at the left of the chart and this market makes this move down, and then we have a consolidation. So your thinking is that I would expect this thing might run into my expectation number 2 for the pullback is the measured move objective. I'm just using my eyeball, I'm not measuring it there. And the fact that we blasted through that, what does this tell me? It gives me a piece of information, which you also can get from the chart, right? You can just see that line, if it were straight, is longer than that line. However, there's a subtle aspect that you can't just like start randomly comparing swings. But the fact that this went so cleanly through the measured move objective told us maybe to look for another swing down. And then you will start to see when momentum starts to roll off at the ends of trends, you will see that measured move objectives are not quite hit. Or you'll start to see another way to put this. All of this ties together, right? There's a method to this madness. This is looking at where you don't extend past is really just like reaching that target number 1 in many cases. So that's why we lay those out like that. We talked a little bit about fractals. What is a fractal? This is worth spending a little bit of time on because there's another point of confusion, another thing that people like to say about technical analysis that's almost true, and you need to know how it's true. So a fractal is a shape with fractal dimension. Everybody talks about the self-similar shapes. And what this is if you zoom in, even like super tiny levels, you will you'll see a shape that looks a lot like the shape, or in some cases exactly like the shape on a bigger time scale. These are used in a lot of computer modeling because the code to generate, if you're, imagine you're generating a coastline for like a map in a game or something. If you want to get every little wiggle of that coastline, and there's a lot we can talk about with like, fractals. Technically, you can have fractals that are essentially infinite length and 0 area, which is kind of cool. But if you were to model every little jiggle of a coastline, it'd be a ton of data. But with very simple code, you can generate a fractal that's quite convincing. These have a lot, many uses. Here are some examples. And you can see this is the process where you have this very famous snowflake. You just keep adding triangles. You can go to infinity, and probably the most famous, maybe because it's the prettiest, is the Mandelbrot set. And what you would see here is you zoom in, it just looks like this. And of course, you can colorize lots of different ways. Now, as I said, people really get stuck on this in markets. And one of the things that you will hear is that patterns are the same across all time frames because markets are fractals. And so what this would tell me is that, and this is in fact one of the claims, that you can take any tool, any trading system, trade it on any market or any time frame you choose, meaning that if I had a 1-minute chart, I could trade it precisely the same way I would trade a monthly chart. I'm here to tell you that's false. That is a lie, but it's a lie that you will hear over and over and over. What's the truth behind the lie? Well, so this is actually true. What I've done here is I'm showing the decomposition, I guess, of this ABCD move on different time frames. If you're just kind of stepping back and looking at a daily chart, you might see my red line. But then if you zoom in on an hourly, you discover that this move that looks like this actually has within it its own ABCD structure. And then guess what? Of course, right? You keep going down and you discover that, okay, well, but that move has nested within itself that. So this is, you do see this move of impulse consolidation and impulse. This is true. This is nested. The market nests these patterns on all time frames down to even the lowest levels. What does this look like, though? Here's some examples. And just to kind of orient what we're looking at, we don't need to, let me turn off the webcam here so you can see a little better. Weekly, daily, and then sub-daily, but a pretty high time frame sub-daily S&P futures. Let me just flip through these panels so you can see. Here's hourly, 15-minute, and then 3-minute. I'm going to go back and forth here for a moment. And then here's 1 minute, 15-second, and 3-second. Now, one thing you will notice, let's just pick a good example here. Let's look at the extremes. Look at this 15-second and 3-second bar. And now look at the daily in the middle, or the, I don't, it doesn't really matter what you look at here. So look at the daily or weekly, and now look at the 15 and 3-second. What difference do you see? I'll go back and forth one more time. Here's the daily, 15-second, 3-second. So one issue that should start to jump out is we start to see a lot of this kind of action. And the 3-second looks a little bit weird. And if I go even lower, it starts to look even weirder. So this is a 1-second bar on your left, and then 10 tick and 2 tick. So, very, very zoomed in. Now, the difference here is granularity, because between these, for those of you that don't know this market, between these grid lines, I did deliberately leave grid lines here, there are only 4 ticks. So this market can only be here, or here, or here, or here. Well, there's 4, there are 5, I had to derive 5 line, but you know what I'm saying. There are 4 ticks in between each point. So these are the only possible places the market can be. That granularity is not really a factor at the weekly and daily level. But even here, if we zoom in on this, let's look at this 3-second bar, you do see this kind of structure, right? You have a move, you have a pause, and then you have another move, and that's all happened in the space of a few seconds. You have a move. Now, are these tradable? Well, yeah, at some point, the other issue with trading on this time frame is your transaction cost is a tick. So to get in and out of this market will cost you that much. The tick here is about that big. So it's still meaningful in the 1-minute chart, but if you go up to the 15-minute chart, I probably can't even draw it. The tick is like less than that. So to actually trade on these very short time frames, which is seductive. A lot of traders think they're going to do it. This is why scalping has such an appeal. You can't do it because your transaction costs on these charts here, it's half a grid line. But you do in fact have the ABC structure here. There are also some other differences. So what I would like you to realize is that be very careful of the claims that markets are fractal. They're not fractal. Markets are fractal-like. That's technically the term. And what is similar across time frames is that this idea of a market making a move and then pausing and making another move, that is valid. And if you're a tape reader, meaning that you are zooming in and looking at how orders are hitting the books, what you're responding to is this still this ABCD structure, but sometimes on a even sub-second level. It's there, but you're not going to see the same patterns. You're not going to be able to trade them because liquidity and granularity are significant issues. There are also the patterns just are not quite the same. They're similar. Do be aware that some time frames have built-in characteristics. For instance, I remember when I started trading 4-hour charts, and it's not a time frame that I had ever. Currency traders trade 4-hour charts quite a lot, but one thing you will discover with 4-hour charts is that take a 4-hour chart of the S&P, you will have overnight action where the market just doesn't move. So you very reliably will have in a rhythm a number of bars that are very small, and then you have these gigantic bars on the New York Open. You have a little more volume and liquidity in the London session and in the Tokyo session. So you do have this more or less predictable fluctuation of volatility on different time frames. But this still, even with these issues, the core idea that markets move in alternated periods of strength, weakness, pause, consolidation, that's absolutely valid. It is, in fact, the fundamental aspect of how markets move. Folks, let's take a little bit of a pause, and then we're going to come back in about 5 minutes and look at some definitions of trend, and this will be fun. So I'll see you back in about 5 minutes. Okay, welcome back. So let's jump into some precise definitions of trend. And my goal here is to, none of these are going to be perfectly satisfactory. So I'll give you the punchline again up front. There's no indicator that we can put on a screen. There's no line we can draw on a screen that says with a very high degree of probability this market is going to continue trending. So why are we looking at so many of these? Well, I think all of these have something useful to teach us. And I think also one of the things that I hope to do today, actually in all of these sessions, is to provoke a way of thinking, to challenge you to think very, very deeply about these things. Because when I started, you know, I think I was fortunate in a way when I started trading in that I didn't have a lot of money to throw around. I could not, and now I work with traders who, in many cases, have lost pretty staggering sums while they're trying to learn to trade. I was having to learn to do this on a shoestring. So it was very important to me. There's a positive and negative to this, of course, as there is with everything, but I could not just go throw money around. I had to do testing. I had to do a lot of research to understand if I was going to do something, did it really have a reasonable, did I have a reason to think that it might work? And the negative side of this, I will tell you, for those of you who might be in the same situation, is I think it did two things to me that were not great. One, it made me a little afraid to execute because if you have a small account and every loss is really significant, you can get you can get a little punched in the face with every trade. Tens of thousands of trades later, I see that was the case. The other thing that I think that it did for me is in making me be very quantitative and very structured, it I sort of demoted a lot of the subjective factors, the things that we're talking about with, kind of the art aspect. For me, I would constantly go back to, if I can't quantify it, if I can't express it in computer code, how do I know this damn thing's going to work in the future? And it's not a bad way, if that's the negative, I think the mirror image negative where you're completely subjective and just kind of hoping for the best is obviously worse. But it took me a little bit of time to put all of that together. But what surprised me when I started doing this testing was that it wasn't that difficult to do rigorous testing of trading ideas. Advanced math was not needed, which was good because my formal education, I was a musician. I certainly did not have anything that could be described as advanced math adjacent. I discovered that what you really had to do was do a lot of very basic work and do it in a very rigorous way. And the model for this was Galton, who did a lot of the work on genetics with peas and with some controversial work with human intelligence, but I think with attractiveness too. Did he had it was just counting, and there were basically he would punch pinholes in a piece of paper. And I think one of the controversial things was that he went around different parts of England and tried to assess how the percentage of the inhabitants he thought were attractive in different areas. So yeah, it's good with bad, right? But the idea that a lot of, and I didn't know this until I kind of reinvented the wheel myself, but you can do a lot of very significant work with very simple tools applied rigorously. And one of the things that still frustrates me today is that this is just not done in technical analysis. You will see people publish books where they talk about the best moving averages or the best candle patterns, and those claims do not survive 4 minutes of mathematical scrutiny. So people are just not doing this work. But the problem is also that readers do not demand it. because a lot of this, I should have had this slide here, but any of you remember the show The X-Files and that poster Mulder had on his office wall that had the flying saucer and the text, I want to believe? A lot of traders are like that, and you have to, you can certainly go too far. One of the people sometimes say that I'm a little bit cynical. Well, a little bit. I will show you today why I'm a little bit cynical. I am, but it's because of what happens when you start testing these ideas. You do want to be a cynic, and you don't have to be, but it's your money. And if you're going to be successful, I think if you're going to trade, let's do everything we can to make you successful. And I think thinking about trading ideas in a very rigorous way, one of the ways to get you there. So let's look at some definitions of trend. These are definitions that kind of exist in my head. Some of these I think are better than others. Dow Theory style market structure, we're going to spend a few slides on that. In my extensive free trading course, we spend a lot of time on that. In this book, the Art and Science of Trading. I'm not selling books, but I do want to point out there are some really cool charts in here and really cool market history, but there are a lot of charts like this where I just took history of markets and reduced them to swing structure so you can see how this works in the real world. It's a useful framework, but it doesn't quite do what we want it to do, because what we want it to do is impossible, right? The highest high of end days, so like a Donchian channel breakout, common sense. It's actually not as bad of an approach as we think. Different, and then we're looking at different indicators here and trend lines. So we'll look at a bunch of these. Let's look at Dow Theory swing analysis. So this is loosely based on the work of Charles Dow. Now, I do want to point out that Charles Dow was a genius in that much of what he said or wrote about markets appears to be absolute common sense, but nobody had really articulated it beforehand. However, what you need to realize about Charles Dow is that all of his work was oriented toward predicting the business cycle by the movements of the stock market. We've turned this around today. But what he was trying to do was to say, I think the economy is going to be really good based on what the stock market is doing. And our focus is on predicting the stock market. But just looking at this swing pattern here. So here you have a market that's making a clear pattern of higher highs and higher lows. This is, we would say, a Dow theory. And there is no Dow theory. People collected his writings, and we tried to kind of back into what he might have recognized as his theory, but he never wrote this down with clarity. But so when we talk about a Dow theory swing analysis, we're using a reconstruction of his thought. And this higher highs and higher lows is one workable definition of a trend. Now, how do you change trends? So if you have been in the situation where you're higher highs here and higher lows, once the market makes a lower high, this is a trend change condition, because wherever we turn up from here, we made a lower high and took out this previous swing. Wherever we turn up from here, we will now have the condition of a lower low and a lower high. There is also this other condition which you see in option number 2 here, where you have a market makes a big volatile move down. So you have a lower low, and then you've hammered in a lower high once you extend there. We're not going to spend a lot of time on this. It's something that I think if you're a newer trader, this definitely is in the category of learn it so you can forget it. If you spend time working through all of these exercises that I proposed, this is not a tradable system. And it's one of the legitimate complaints. Why would I spend so much time doing something that's so fussy, and if it's not going to be something I can trade? The answer is, and this is real, because it will create a structure in your, it'll create like these pegs in your mentality for how you understand market action. And it's worth doing, and then you can forget it and it becomes background. Really what we're driving at here is a length of swing analysis, and I hope you see right away this connects back to the measured move objective. So what we're looking at, if you just look at the vertical distance, that's what these examples show, and an uptrend, the upswings will be longer, usually in price and time, but this would affect the angle of the move, but certainly in price than the downswings. That's the only way you keep getting these higher highs is if these moves, I'll just highlight the upswings here, are longer than the preceding moves. As soon as that is not true, so look at this here, now I'll use a double dash. This downswing is bigger, larger, greater magnitude than the previous upswing. So this is another way to say the same thing, that another way to lay out that higher high and higher low. One of the other things that you should be aware of here is that reducing length of upswings shows a lessening of a conviction. This is one of the signs that a market's running out of steam. Another way to see it here is look at this high and then look at these highs. Yes, the second one, this is higher, but it's less higher, right? So it makes a marginal, a small new high. That's evidence that the market is running out of momentum. I think the biggest message we can take away from the swing analysis is that if you see a large counter trend shock, so you've had here this market that's doing its nice uptrend thing, and then what happens? Boom. You have the big move against that certainly takes out the previous swing, and maybe even sometimes takes out more. This shows you that the trend has changed. Now, let's go back. Let's very unprofessionally page back through a bunch of charts. Let's just look at this here. So this is back on our measured move chart, where we have this market that's making lower lows. Look here, lower lows, not a lower low, but that's okay. Lower low, lower low. And then what happens? Look at this move. So this is a move that is, let me mark it with more precision. This is a move that is totally incompatible with a downtrend. The previous upswings, this swing and this swing, are those not a downtrend anymore? They're definitely up, but they're not clearly not a downtrend. And we did have here, this is a higher high, and we've now had a lower high. So officially, you would have changed trend, but the real message here is this sharp move up. Look here. Real message here is this sharp move down. So that is not really compatible with the uptrend. Now, sometimes you will have smaller distortions like what happened here, but that's what keeps all of this interesting. Remember, all we're doing here, all we can do is to be able to tilt probabilities. This is a very important message to be sensitive to. One of the problems with learning to read markets is you don't know what to pay attention to. And if you, again, here's my complaint with a lot of what people teach. If you think that you're supposed to look for some special pattern, a lot of people are talking about the broadening formation now. Like that's the most important thing. It's not the most important thing, it's a thing. Or, if you have some candlestick pattern, pin bars or whatever, and this is the most important thing, it's not the most important thing. It's very hard to say what the most important thing is, but a clear shock level disruption of an existing trend is perhaps the most important thing. This is a good place to start. What are we trying to do here? It's very easy to go back and to look at any chart and say the market was trending or downtrending. We still need to, we can argue over definitions, but defining on past data is easy. The only thing we care about is whether a definition of trend says something about the future. I already gave you the punchline here, but here's the bad news in red. There's no mechanical definition that meets my standard. There's nothing that I can reliably say we're going to trade this market in a trend versus a mean reversion mode. Soldier on with me. There is also some very good stuff to come out of this. So let's look at some of these trend measures. I'm going to show you a bunch of things that don't work, but the goal here is not to show you how smart I am to figure that out, and I certainly don't want you to, on a personal and subjective level, I have to say this because one of the pieces of feedback I've gotten from some of the traders I've worked with is that these messages can be very discouraging. I'm going to show you, I don't know, half a dozen things here that don't work. And some of these things you might have come into this presentation thinking they work. So it's very easy to walk away from this and to be discouraged or dejected. I don't want you to have that feeling. I genuinely don't. But what will happen, what I can say with a high degree of reliability, if you trade, it might take you a long time, but you're probably not going to be successful using tools that work, or that don't work. Or if you are successful, you're going to be successful despite those tools. You're going to be either ignoring them or twisting them in ways that make the tool of kind of questionable validity, and you probably would be doing better. You very likely, I would almost bet that you would be doing better without this tool. So I think it's very important to understand what might actually be working against you. And I'm also not trying to tell you that everything is useless, because there are some things that are very useful. Rather, what I want to do here is to show you how I think about the market problem, how I think about evaluating tools. I want to give you some frameworks. These are simple. These are very, very simple frameworks. You can start doing it today, and this will point us toward things that work. Look at your screen here. So this is a pretty common trend indicator. You just take the slope of a moving average. And if that moving average is sloping up, so we're not saying if price is above, this is the slope of the moving average. If the moving average is sloping up, the bars are colored blue. If it's sloping down, the bars are colored red. Again, I'm going to hide my webcam so the chart's a little bit bigger. Take 10 seconds. Look at this. Is this a good trend measure or bad? So what you can expect from any trend indicator is that it's not going to work all the time. You are going to get whipsawed. So I would not be concerned by this red. There's actually, I think, a little bizarre red in there. It happens. It's not something to be overly concerned about. You should also expect that any trend indicator that anybody would even contemplate will catch a lot of the big moves. So look at this. Had us long here. Looks like it had us mostly short here, right? And we were short through this, woo, right? Um, got a short through that stress. So is this good or bad? Um, what question are we actually asking? So here's what I think is the basic question. When a trend indicator shows the market is an uptrend, is the market more likely to go up or down? In the future, however, all we can evaluate is when an uptrend was indicated on past data, was the market more likely to go up or down? That's the question we can answer very easily. And no one ever asked this question. You're not going to find this in very many books at all, certainly not books about technical analysis. Keep in mind, we only care about these tools for what they can tell us about the future. Maybe we can understand the present balance, what is happening right now, but when we act, we're only going to be influenced by the future. Here's the problem. So this is from the book. This is the slope of a 50-period moving average. Now, if you just eyeball this, you would notice, okay, so this has us like, it catches this downtrend, right? Okay, and then it catches this uptrend. This looks pretty good, but the issue is lag and the fact that it actually flips you short here and it actually flips you long here and it actually flips you short maybe on this close. So this is probably this window on the screen, if we were to evaluate it, the trend indicator would be profitable based on this little snippet. But in the bigger picture, this lag completely erodes the edge. And in fact, using these trend indicators will put us on the wrong side of the market. I'm going to show you numbers in a moment. We'll come back to this, but let's look at ADX DMI. So this is, I went to the CMT Association, and for the most of you know probably, but this is an organization that certifies people as having expertise in technical analysis. There's a vast reading list. Many of the standard books of technical analysis, people have to understand the tools and the nuances and the standard application. So I wanted my goal here was to find an authoritative understanding of this tool, ADX DMI. This was created by Wells Wilder, who also created the RSI. This is the directional movement index that we don't need to, if you're interested in how it's calculated, and you should be if you're going to use it, you should know. But let's worry about the actual signals. So the buy signal is generated when the DMI crosses through the positive DMI crosses through the negative. And of course, we know the reference to colors could be different on your screen. There are two pieces to this. There's the ADX and the DMI. There's the DMI buy and sell signals, which we'll evaluate separately. And then there's also the ADX. So this is an oscillator that shows, and this is critical, trend strength. Low readings below 20 indicate a weak trend. High readings above 40 indicate a strong trend. And when there really, I think here, two claims, right? There's the level claim, and then there's also the slope claim. And we acknowledge these certainly could conflict, so we should look at both of them. The rising line means a trend is strong and a security is a better candidate for a trend following system. That seems to me to be testable, right? When the line has a negative slope, the trend is weakening and a trend following system should generally be avoided. I bullet pointed those arguments here, and now let's look at some data. So this is the ADX, and I have colored the bars. You need to understand on each of these slides what the coloring is. In this case, if the ADX is greater than 20, I've colored the bars blue. If it's less than 20, that was the claim here. Low readings below 20 indicate a weak trend, and high readings above 40 indicate a strong trend. So here is above or below 20. So interesting thing here is that this does not look to me like a particularly strong trend. If you're evaluating these things subjectively, and we'll do this quantitatively too, but I do want to point out that this evaluates the downtrend as being strong here. And of course, that's exactly the moment where the trend changes. Here you have an emerging uptrend that, of course, is marked above 20, kind of right at the peak. I have several slides here. I will just page through these. If you thought this one looked perhaps acceptable, I do want to point out that all of this is marked as a very weak trend. And in fact, what if you were to, and this is a trading strategy, this tool works so poorly that some people have suggested fading it. So what would happen if you look to short where it went blue? Well, works sometimes, doesn't work other times. There's no edge here. Here is a very strong downtrend, which certainly look at the 2 points, and here's a very strong uptrend. And oh, look, here we went above 40. So these are the areas where we were told the trend is strong. Here's another. I think you're seeing the point. Let's look at the slope here. So these bars, now when you want to visually define the slope of a line, that's something that you can play with. And if you haven't done this, what I would suggest is, what I've done is just saying if today's value is lower than yesterday's value, then the line is sloping down. That's maybe not the best way to do it. If you want to play with some kind of slope indicator of a line, drawing a linear regression, which sounds complicated, but it's easy to do mathematically, through the last few points and then taking the slope of that line, it's probably a better way to do it. Spoiler alert, if you do that, you're going to see a very similar answer. But just ask yourself here, so when the line is blue, the trend is strengthening, and when the line is red, the trend is weakening. Does this look like this would be useful information here or here? I would argue no. Why am I picking on ADX? Well, this is because this is kind of a poster child for the issue with traditional technical analysis. Every charting package, every website you have, you can put any chart on will have ADX DMI. And anybody taking any kind of technical course, course in technical trading will run into this. Any book talking about indicators will run into this. There is an interview which you should dig up, Wells Wilder late in his life, where he and his wife were interviewed about the book that he wrote, where he laid out ADX and RSI, ADX EMI and also RSI, and he admitted again, just like the Bible technical analysis we were discussing, he was not able to make money trading with these tools. Yet, armies and armies of traders to this day continue to struggle trying to put these tools into application when the creator was not able to make them work. Does this work? Well, it's hard to tell by looking because it's very easy visually to underestimate the cost of whipsaws or to focus on, let's be honest, this does work sometimes, right? Like this had us in a strengthening trend here. This had us in a strengthening trend here. So maybe that's good enough to overcome. You can't really tell visually. If you are reading an analysis that somebody did, here are things that I think you should be careful of. If there's no measure of significance, if there's no out of sample work, and if they present, simply, I did these back tests on these 40 different settings of the stochastic indicator, and here's the one that had the best P&L. That's not how you do a back test, and this is extremely misleading. Here's a very easy way to evaluate any kind of trend indicator. We simply bin bars. This is back to counting. This is back to punching holes in a piece of paper to categorize things as yes or no. And all we need to do is take the trend indicator, and while it has one condition, we say it's an uptrend, and then we just average the return for all of those days that had an uptrend. And then we do the same for the down, and some trend indicators might be neutral. It is very, very, very important if you do this that and let's go back to one of these charts just to be clear. So what you would be doing here, this is looking at the slope of the ADX line, trend strengthening, trend weakening. Well, obviously we would have to separate uptrend and downtrend or they would cancel out, right? So we need the DMI for that. I did that work in a moment. But what you have to be very careful to do is to make sure you get the day that flips correct. This is, I'm not sure which one this is. I believe maybe this is a slope at the 50 period. This is the real data. You're going to see several of these. So let's make sure we understand this. This is in basis points. So this is telling you on the market that I was looking at, the average return, and return just means percent change. The average return for each bar was about 5 basis points. So that's 0.05%. I'm now looking at excess return for the up and the down, and there were no neutrals. What the excess return is the return minus the baseline. There's a question here. What do I mean when I say by above baseline drift in trading analysis or in any kind of analysis? What this means is basically, let's say you were looking at a system where you were swing trading the S&P. and you come to me and you say, on this sample of data, my system makes an average of 7%. Well, that 7% is the same amount you would have gotten by buy and hold. Might be the same amount you got by buy and hold over that period. So if you were, another way to think about it, buy and hold is just capturing the whole thing. What if you were to just do random trades? That's another way. The question is, does this thing really look any better than what we would expect if we just did something random and just pulled like random days out of the market? And so what you have to do is you look at the amount that you made from your trading system as a percent ideally, and then you subtract that buy and hold return. That's one way to do it. The baseline is the buy and hold. You got to do better than that. So what I've done here is for each of these, I've subtracted this baseline drift here. So, and that gives us the excess return. That's what excess is. So what you actually see with this particular indicator is, first of all, these numbers are basically zero. 1 and 2 basis points are almost certainly inside of transaction costs. Like, this is not economically significant. But what we see is that the up number is actually negative and the down number is actually positive. This means very, very slight, but it means that when we had an uptrend indicated, the market was actually more likely to go down. And the reverse is true. When we had a downtrend indicated, the market was more likely to go up. So if you had used this tool, well, in this case, the numbers are pretty close to zero, but you actually would put yourself on the wrong side of the market. However, so what I've done here is the day that the day that flipped us long, the day that flipped us to an uptrend. So that day you would have had the downtrend or the neutral condition before. You understand? You don't know until the close of the day that this is going to be an uptrend day. So if you make the mistake of categorizing that day that flips with the trend indicator, you get numbers that look like this. I didn't say that very well. Let me try that again. I'm sorry. If you if you're offset by one day, so you don't know until the close of the day that that was an uptrend day, your uptrend condition does not really begin until the next day. That's what I'm trying to say. But if you were able to go back in time, if you were going to trade this, what you would have to do is jump into your TARDIS and go back to the previous day and buy on the previous day's close, which is impossible. So if you just think about this logically, if you think about how would I actually execute the trade, and you'll see that's impossible. But if you allow yourself that mistake, which doesn't seem like much, what you've done is you're just off by one day, but now look at the results. Now the negative is much larger, right? And is in fact negative. So we flipped the signs and they're big enough to be potentially significant. And this mistake was made by just miscategorizing the day that the signal flipped. This is a very common mistake. I've made it many, many times myself. And this is, one of the things when you're doing any system development or testing, when you get something that looks too good to be true, it's not true. You made a mistake. And this is one of the common mistakes that people make. Looking at this, let's go back to the 50 period moving average. So this is from the book. Was not actually published in the book, but this work was done in 2010. And this is looking at the trend indicator for the slope of a 50 period moving average on daily bars on a very large set of data. So we looked at over 1.3 million daily stock bars, 40,000 futures. This futures universe did not include currency futures, but included agriculturals and financials. Those probably should have been split out a little bit differently. Roughly 16,000 FX bars, and then a large set of randomly generated data just to give us that comparison to a baseline. If we look at the slope of the 50 period moving average, there are a lot of numbers here, but let me highlight a few. So this is for the downtrend. The upper part of the upper panel is for a downtrend. You were pretty reliably positive. and here is an uptrend indicator, you're pretty reliably negative for stocks. But look what happens for futures. The signs are actually flipped. So there are definitely some nuances, and the forex comes pretty close to zero. And if you want to compare, here's a no edge market with a random market. This also points out that there are some differences in how markets trend, both across different regimes, across different time slices, but also across different asset classes. So if you are, and this is old data, let's look at some newer data, and I gave you much simpler tables. So what I've done here, I'm going to show you now a bunch of trend indicators with updated stats. And we're going to look at daily data, only the S&P 500 futures. Now, you might say, but Adam, what about, and you're right. However, I'll stipulate, whatever you're going to say, what about, you are correct. However, my argument here is that if we're looking for a valid trend indicator and it sucks on the last decade of the stock market, it's not a very good indicator. So that's my thinking here. And again, none of this is to be peer reviewed or published. I'm not trying to prove a point, I'm trying to illustrate a point. So this is not exhaustive. Here's the slope of the 50-period moving average. These numbers that you see here for the stats, these are over the last 10 years of the S&P daily data. And you can see the downtrend is slightly positive, the uptrend is slightly negative. So if you were using the slope of 50-period moving average, you were on the wrong side of the market with a high degree of reliability. Other people say, what about a triple moving average trend indicator? Because so one of the very, very early trend indicators was to look at the position of two different moving averages. So you'd have a short term and a longer term, and you would say if the short term is above the longer term, the market is trending up, and if vice versa. And so then people were like, well, if two averages are good, maybe three are better. And I have even seen ridiculous people talk about ribbons where they use like 20 different moving averages. It's very pretty if you use the right colors. You can draw really nice charts, but different transparencies and shade, all kinds of things you can do. But you're not actually doing anything that is useful for trading. This is a very common trend indicator that many, many people are using. And the way it is constructed, you can use any inputs, 10, 20, and 50 are pretty commonly used if the moving averages are in the right order. So what I've done here, the moving averages are below the price, but so here's the fast moving average, here's the medium, and here's the slow. And when they are all correctly ordered, meaning the fast is below the medium, is below the slow, the market is in a downtrend, and I've colored the bars red. And when they are all in the right order to the upside, I've colored the bars blue. Anything else, one of the nice things about this trend indicator is that it reflects that we could be uncertain about a trend. So this will give us the very logical and correct answer of, we don't know sometimes. So, that's what the black is, any other arrangement. Now, we should also point out, we could look at slopes of moving averages or whatever, but this is a common indicator. And I just want you to look at, I'll give you a few seconds here to absorb, and you'll have the slides so you can spend more time with them, but just look, do you think this moving average indicator works? Would you like to be long only when the bars are blue and short only when the bars are red? There's one more after this. Pay attention to your subjective sense. What do you think? I mean, you obviously know where this is going, but even with that, you might acknowledge here, okay, it doesn't look so great here, right? But we don't expect anything to work 100% of the time. And even here, I don't know. I mean, like I've looked at a lot of these charts. My subjective sense here is maybe that looks okay. That looks probably pretty good. Looks pretty good. Looks great, right? That's my personal subjective sense. However, here are the actual numbers. Uh, the up is pretty close to zero, but negative. The down is positive. So if you are using this trend indicator, you're putting yourself on the wrong side of the market all the time, very, very reliably. And many people do things like they use this as a filter. They want one of the popular ways to use a trend indicator is to say that, I will only take long trades. I know the trend indicator is not a timing tool. Okay, correct. So, however, it's going to give me a bias, and I'm only going to take long trades when the trend indicator is up. And you might complicate this by using a different time frame. You might say, I'm only going to do this when the trend indicator on the weekly is up, then I'm only going to take long trades on the daily chart. That's great, but the problem is you are still yeah, I'm trying to look for a phrase here other than pissing into the wind. You are still doing something that is the wind is against you. You are putting yourself on the wrong side of the market. And maybe are you able to overcome that with your timing signal? Perhaps so. If so, good for you. But if you're struggling under this, I would have to ask, how much better would you do if you remove that trend indicator that's actually hurting you? I do have another slide here that gives the old data from the book. You can see it's very similar. We're not going to get caught up here. Here's the DMI. So this is DMI plus and minus, and you can see these numbers are very, very close to zero. It's curious. I think I just got lucky that these are so close to zero, I wouldn't take much from the directional bias. But DMI, naked DMI, puts you slightly on the wrong side of the market, let's say. I guarantee that would fail any significance test. However, if you add the ADX 25 filter, which is one of Wells Wilder's suggestions, this probably would pass significance tests, and it's backwards. So again, down is up is down, neutral is whatever. People also use a close above and below the 200 period moving average with the absolutely unsupportable claim that institutions watch it. What does that even mean? Well, that's something you tell people in your YouTube videos because you want it to sound important, but you don't actually know. No institution is banging in and out of a stock because it crosses 200 period moving average. And you can see the numbers here. This is not a reliable measure of trend. I use for years and years a 20 period moving average, exponential moving average on my chart. More and more now I'm using a simple moving average. Doesn't really matter. I never used it as a trend indicator because I knew if I did, and this is not the slope, this is the close above and beyond, it would put me on the wrong side of the market very reliably. What about the turtles? So everybody likes to talk about trading with the trend. It's a very well-marketed thing today, right? And the turtles, for perhaps some good reason. If you don't know about the turtles, you should know about the turtles. Google the turtles. The first Market Wizards book, I think the first one, includes some interviews related to the turtles. This was a group of traders. It was an experiment to see if trading could be taught. And in Chicago, people answered a newspaper ad that said, "You want to be taught how to trade?" And what's the probability of that being a scam? Pretty high. In this case, it was not, because some of the most profitable money managers in history came out of that program. Some of them also failed, by the way. That's important to know. They were taught a system that was based on, and these rules are completely disclosed. If you Google the turtle rules, you'll find that one of the turtles published them in exquisite detail. There were two systems. One was basically based on buying a 20-day breakout. So what you would do is create what's called, Richard Donkian was a early technical analysis author, and he wrote a lot about this concept. You would set up a channel where you would want to be long above the highest high of the last 20 days. If today's close is highest close or something, some variation like that, Then there was a slower system that was based on a 55-day breakout. There were also a lot of very revealing rules for how you got out of a trade, the position sizing was done based on volatility. All these rules are worth understanding, but because there's this mystique around the turtles and their undeniable success, a lot of people still lean on these channel breakouts. So what if in the last 10 years of the S&P data, you were simply to buy a close that was the highest close of the last 20 days, or short a close that was the lowest close of the last 20 days? Again, you see the numbers are pretty close to zero, and it puts you on the wrong side of the market, at least slightly. How can this be? Well, so one thing that we need to be aware of with any approach that's based on trend following, is that there's considerable evidence the market has changed. The markets have changed. Markets have changed. And that these naive follow the trend approaches might not be profitable. For instance, here is looking at the Dow, not the S&P, but looking at the Dow cash index. And I know you can't trade the cash index. That's a legitimate argument. But looking at this 20-day channel breakout from 2010 to present, you see numbers that look pretty close to what I just showed you on the last 10 years of the S&P. However, if you were to go back and look at this data from the 1960s to the 1970s, look at that, the signs flip. So perhaps this is something that you could have traded profitably then. And I don't want to get caught up in this, but I just want to show you some charts. This is comparing it's not that distant past, but here, imagine that you were trying to extract profits from following a trend in crude oil. This is from 1984 to roughly 2000. And here's more recent data. So I have several of these. So this is weekly data. And what I think I would point out here with the more recent data is that there are significant periods where the market is flat. Much more of this is flat than you see here. Yes, of course, you do have some periods where the market is flat. And the other thing that we need to be aware of are these kind of nasty spike reversals. This hurts if you're a trend follower. This hurts a lot. Now, it's not like that didn't happen in the 1980s and 1990s. Something in the early 1990s that caused the crude oil market to move a little bit. As you know history, you know what it was. You certainly did have these, but you had fewer of them. Let's just look at a few more markets. This is actually the gold market from the late 70s to the mid 90s. And yeah, some kind of nasty spikes in there too, but overall a fairly predictable trend. And the character of this is a little bit different. This is a nightmare for a trend follower here, where you have these kinds of spikes. And this is quite difficult too. Corn futures. Again, it's not like this was ever easy. Here's corn in the late 80s where you did have a nasty spike, but a lot of this trends, if you're a trend follower, you probably don't know what to do with the money you're making here. And this is pretty good, and this is pretty good. And even this, you do get some kind of reversal. And here, there's just a lot more of this. And I know, looking at charts, I love to complain about this. Looking at charts is not really analysis. We're not doing analysis, but we are subjectively seeing if we can pull out some difference in trend character. And I think we can. Look, you don't really see that kind of action in the older data. There also, you can look at trend following indexes. These are measures of performance. These do many times have survivorship bias, meaning that the indexes are redone. And it's pretty revealing, I think, to look at how difficult, and Tom and I have friends who run funds like this, and it's a struggle. This is, why are we so far in the weeds on this? Well, first of all, it's something that a lot of people talk about. A lot of people focus on the idea that I'm going to catch these big trending moves. Since we were talking about trends today, I thought it was worth looking at the complexities and difficulties of this approach and maybe challenging you to kind of think around the corners. So at the end of all of that, I do think it's worth asking if we can't find any measure. I mean, look at these great colored charts, right? If we can't find anything like this that reliably biases future market action, and I've looked at some pretty crazy things. I've looked at simple math and advanced math, and I haven't found anything that I consider to be reliable. So, is there any value in this work? Um, yes, there is. There's great value in understanding what the market is doing now, so we know how to trade it in the near future. And we're going to take a big break. We're going to take a short break, and I'll come back and share some thoughts on that. Okay, here we go. So I want to show you how I do this, how I think about this on a daily basis. And this is kind of a cool quote, in my opinion, that found its way into the book. What we need to do from a practical perspective, and we can't cover both of these things in full detail today, but we need to think about both big picture. The swing analysis that we've talked about with the Dow Theory type analysis is a pretty good guide. It's a good framework. It's a good structure. We're going to go a little bit beyond that. The other thing that is very useful is looking at small patterns. So what I mean here, for instance, would be there are some candlestick patterns that are useful. Now, when I say that, I don't mean these candlestick patterns that people have named. I mean looking at things like the relative size of candles, the position of the close within the candle, and the presence or absence of tails, how the market is acting around support and resistance. Those are important patterns, important factors. The way the pullback pattern resolves is also important. We talked about that quite a bit at the beginning of the presentation, where we were looking at big extensions or small extensions. And again, all of these things are nesting together. We're looking at the same thing from different angles. When I say how a market is acting around resistance, let's say we're in an uptrend, that is going to have overlap with those pullback resolutions. Think about that. Remember your pullback resolutions? One, getting back to that previous pivot. Well, why is that important? Because that's an anticipated area of possible resistance. What happens at that previous resistance level? Well, if we only have the pullback with the like step one target, so we hit that, and then there's maybe price rejection. Or if we have number two, where we go through and have a measured move objective target, that can just hit that measured move. Maybe you can do it on normal momentum. Maybe the momentum can really, accelerate, and we have new strength that can lead to another trend leg. So this all ties together. And then of course the issue is climax, which we'll talk about in a moment. We do see your questions. By the way, questions are really good today, guys. I'll try to get to all of the questions. Many of them we will hold until the end. So be patient with me, but please do ask questions as you have them. So what I want to do now is to take a look at some market data, and I want to show you how I think about trend integrity. Now that's a fancy sounding name, but all it means is, do I think this market's going to continue trending? That's the question we're asking. Is it safe is it smart? Does it make sense to try to trade a pullback in this trend because I have an expectation that the market will continue to trend? To be able to do this, we need to understand how trends begin and end and how they typically continue. Now, again, this is all the same thing, right? Because if we understood how trends ended, I've said this before, then if that's not happening, the trend is probably continuing, right? And so we're now going to look at this down at the pattern level. We're not going to focus that much today on endings because that belongs in a future session. I do also want to point out that for those of you who come from a quantitative background, when I say how something feels, or when I talk about the character of something, don't be afraid of that. If that's an unnatural way for you to think, get comfortable with that, because you are going to get information and intelligence from these subjective measures that you might very well later be able to quantify. I certainly have in my own work, and we're certainly working with other traders, I've seen people have built algorithmic strategies around things that began with a subjective sense of what people were probably feeling around areas. So you can you can stretch your thinking that way. If you, however, are a very subjective person and you haven't done any of the quantified work, I push you in that direction too, because there's definitely value there. So what we're going to do here, this is a big picture overview. We're going to look at this entire chart. So I've done the S&P futures. We're going to look at a daily chart from 2018 to, I think the beginning of this month was where I stopped, and we're going to go through in little bites here. And I'll zoom in and out so you can see where we are in the big picture structure here. The highlighted area is what we're now looking at here. So this is 2018. A couple of things, and I'm going to sprinkle all of these lessons here based on what's happening in the market, not in any defined. This is the market giving us lessons, not me having a lesson plan that I want to unfold. So what happens here at this previous, and I'm also going to draw and erase a lot of lines. So here, this was a slide along the band's trend. Now remember, a slide along the band's trend is a relatively low volatility trend. How would we measure that volatility? Well, typically we'll see the ranges compress. We'll see that the size of the bars, in this case daily bars, will usually get to be a little bit smaller. We don't have pullbacks. So this presentation is about trends. Actually, I'm going to hide the webcam, which will make the chart a little bit bigger. This is a presentation about trends, and we're talking a lot about pullbacks. You do need to understand this slide along the band's trend action is a type of trending action that does not really have pullbacks. The best you will have in terms of pullbacks in a slide along the band's trend is maybe you'll get some inside bars. Maybe you'll have something like this. Maybe you'll have, this was really before the slide along the band's trend happened, but you will not see structured pullbacks because that is not a slide along the band's trend anymore. We did have a number of free bars here. So the free bar is a bar that is above the upper channel. And I'm using a slightly different channel that I've used in the past, but it really does not matter. At this high, we had a strong momentum reversal, new momentum to the downside. And is this a downtrend? Well, probably, but is it a tradable downtrend? It depends. There is a potential entry here. I don't think it was actually very tradable in real time, but you did have a little bit of a pause, and then notice these two very significant price rejections here. That is important. So one of the lessons here, when you have a market that has a big volatility shock, in this case, you had the volatility shock to the downside, and it was followed immediately by a shock to the upside. Put this in your memory bank. This is very, very important. When you have a market that has a big move down followed by a big move up, the most likely near-term expectation is something that looks like this. Now, is it going to actually draw a triangle on the chart? Maybe not. And there's no guarantee that you won't like make a lower low here or something like that, but you're probably not going to have very good trending trades. You probably are going to have a market that settles in somewhere around that. And if you just want to have a template in your mind, you can do worse than the triangle. So when you have a big shock in one direction followed by an equally big shock in the other direction, it's not a very good trend environment. That's kind of the baseline expectation. At least once you've had this double test here and then this move up, you're not looking for shorts. At the very least, that's what you're doing. Notice down here, we then have another double test. Now, this becomes interesting. The next thing I want to focus on is the uptrend. Let's talk about this uptrend from here to here. This is the first trend in this section, and let's look at how this trend begins. So do you see any point on this chart before, let's just say there, before that vertical line, do you see any like really clear, sharp upward momentum? Thank you, tea delivery. I don't. I think that this is a case where one of the ways that a trend can develop is simply it slipped in kind of under the radar. We don't have an announced shock that tells us all of a sudden we're in an uptrend. But what we realize is we start engaging the upper channel. We start spending a significant amount of time above the moving average. Now, I just told you in excruciating detail that the moving average was not a reliable indicator of trend. And I will double down and triple down on that because that is quantitatively indisputable. However, just the fact the market is able to spend a lot of time above the moving average is a reflection of strength. It shows us, even if there's no point where we can flip a switch and say, okay, now this market is in an uptrend, I do want to notice that we're not able to spend a lot of time below the moving average. Now, of course, if I picked a different moving average, this is a 20 period, if I picked an 18 or a 24 or a 30, it's going to be a little bit different. So that's why and there's nothing magical about, somebody just sent me a fairly hilarious, well, except that it's not, because it was accepted as orthodox, analysis of why the 21 period moving average is vastly superior. A lot of very poor quantitative work was done, and this is now accepted as gospel, if you will. We don't want to do that. We don't want to say the tool itself is important, but it does show us something about the price structure. We also can see here that we had, not that this is a super reliable guide, but if you wait until you start seeing this, where you have here higher highs and higher lows, you don't really get the message until quite late in the trend. Where do you really start to get interested in thinking about this potentially being an uptrend? For me, it's somewhere in this area. It's somewhere here that you definitely had very clear signals here. The market was not much interested in going lower. You do have here some tails that show there's a little bit of accumulation. I think you could start to trade to the upside as early as in here, but you are early, and that's fine. You are definitely trading in the middle of a congestion zone. And I think if you are trading here, the correct stops are at least here and maybe here. So you definitely then that puts your profit targets up here. You're definitely requiring pretty big swings, but the clear uptrend starts to emerge here. Now, the market's not nice. If you didn't know that, you know it pretty quickly, because now you have, if you've diligently studied my book and other examples of pullbacks, this is a failed pullback. This is a pullback that fails by strong momentum against. We're going to look at the ways that pullbacks fail. Perhaps we should have done it before this slide, but this is one of the common pullback failures, a strong breakdown. However, there's no follow through from that. So this is a point where, even with what I would say is the best pattern analysis, you're vulnerable to being whipsawed here. You probably, if you were long here, you probably were stopped out, but you did realize the market was not going down. It's also possible to structure this with a lot of different trend lines. And in this presentation, I have not drawn many trend lines because they're subjective, and I am aware of them from a, like, I won't draw them on a chart, but I will see them. I will sometimes draw them to illustrate points to people, but you do need to be aware of them. And the point where I will draw them is to become interested in this upper channel line, because what happens at this upper channel line is, look only at the dark red first of all. When the market reached this upper channel, it was each time a small setback. It's a good spot to take profits. And even though I do think the trend accelerated into a higher rate of trend, and you obviously could, but potentially draw a trend line like that too, right? These are useful structures to be aware of. Point being, though, this is back to the previous slide, between here and here, what challenges the uptrend? I think this is the only spot. So everything else resolves. You do have some downs. You have here a decent selling bar there. You have a few spots where we ran into pretty decent resistance. The market didn't claw through that super easily. You have something that looks, so we're not talking about this yet, where you have something here that looks a little bit toppy, but there's nothing really here to there that significantly challenges the uptrend, at least in my opinion. Then we get to here. How does this trend end? How did this uptrend end? Well, we ultimately were not much able to extend beyond there. We then had another pullback, and I don't know if that's exactly the same. I think it failed to reach that previous swing. And then we had very sharp downside momentum. Now, look what happened here, because I think this is significant. I'm going to draw these lines and erase them. Look at these bars here. Each of those showed some selling pressure, right? This was what was different. You always want to see what is different. This is the first time in many months that we had been below the moving average for 4 days in a row. You gotta go back here to see something like this. It does significantly come after we were not able to make a new high. And however, each of these had price rejection at the bottom. What does this show? It shows this kind of boing, like the market sold off and there were buyers there each of these days until they weren't. So that's why this bar, this single day, is such a powerful signal. This, at the very least, tells you that the uptrend is over and you don't want to proceed and looking to buy a pullback. Let's move ahead to, this is the next section that we're going to be looking at. So now we have a downtrend beginning with this sharp momentum move I was just talking about. And from this, we can assess looking at the character of this pullback. This is very important. What happens after this move down? Look, I have to page back a few charts. So let's just go back to here. Okay, so look here. Here you had a big move down, and then what happened? You had a sharp, vicious, if I'm using subjective words, you had a really sharp snap back up. Look here, you don't have that. Now, this is not just after the fact. Obviously, we can look at the chart and see the market continue to go down, but what I'm telling you is at this point in time, you would have seen that. You would have seen maybe on this day. So I'm going to draw a couple lines here to the same day. So on this, can you see that? It might be small on your screen, but on that big up day, you might have thought, well, here we go. We're going to snap right back. Not a crazy thing to think. But then look what happens. Your next day, no follow through, and then the market rolls over. And turns out this is a shortable pullback. Now, did we get a measured move objective here? We did not. I don't think we did. I think your measured move would have been somewhere in that zone, from there to there. So this shows, maybe a little bit of a lack of momentum. Then we have here little bit of a failure to bounce. This is not strictly a trend. So this is one of the issues with defining trend, right? Is this a downtrend? And this a downtrend? And then this a downtrend? And then this would be an uptrend and an uptrend. And look, this downtrend had that ABCD structure in it, didn't it? And this uptrend, so all of this is always nested. It's always there. However, you need to be clear on your trading time frame What is significant? What rises to the level that will get you to execute a trade? And my thinking is that this is more range bound, even though we do need to acknowledge some of the strongest trends do occur within ranges. This is potentially short-term climactic for those of you asking about climaxes, and this is pretty clearly climactic. So this is the sell-off into early at the end of 2018, where you had this kind of big dump. And then look what happens. Look at the character of this snapback compared to this. It absolutely, you can quantify this if you want, but it absolutely is valid to think in terms of the character of the market's movements, because here we had very quickly sharp snap off at the bottom, and then look, here's your A move here, here's your little pullback, and there's your upside extension. Now, well, so what might you have expected? Well, I told you when you have a big move down and a big move up, what you might have expected was to kind of settle in there. But you pretty clearly got the message that was not happening, at least somewhere in here. And this was a point where it made sense to start looking at upside trades. Note the slide along the bands trends here and here. These are low volatility trends. They are trends of consensus. When that consensus is upset and broken, we do get large spikes against the trend. That is the danger of trading the slide along the bands trend. It is one of the, and we're seeing a lot more of these lately, it's one of the more difficult trend structures to trade, in my opinion. What is happening here? Look at this. So this is a little, is it a mini downtrend? Well, it's a month and a half, it's 2 months. So it's maybe a fairly significant move. It is, however, also on the weekly chart, on the higher time frame, simply a complex consolidation. Let's flip ahead, look at this next section. So we'll look at this uptrend in 2019. I do want to point out, we've noticed the slide along the bands trends. We are not talking a lot about 3 pushes. And this is because this is a trend ending pattern. This is a pattern that I use quite often myself, all time frames. This is one of the things in the book, people like to say, do you still use what's in the book? And the answer in almost all cases is yes. This is one that we find very, very useful. But I do want to point out, not always simple. So you had here 3 pushes followed by 3 more. It's a little bit more unusual. This third push pretty clearly ended the uptrend, but it took a little bit of time a little bit of time for the market to get the message. One of the things that you will notice about the stock market is, particularly since 2009, we've been in a very convincing bull market. And there are reasons for that. There are macro reasons for that related to the availability of money. But this the stock market certainly recovers in a way. If you were trading gold, if you were trading crude oil, you would not have the same upside bias that you've had in stocks. And the challenge, the danger for all of us is that it has made sense. And in my opinion, as of this recording, June 2023, it still makes sense to be pretty aggressively bullish in the big picture for stocks. That's going to change at some point. And there will be much sorrow when it does, because a lot of people they don't know any other way to think about stocks. But do notice here that the point of that was that this 3 pushes led to a significant distortion. And again, what happens? You have that kind of settling in, big up and big down. This was a particularly difficult spot to trade, because this is the kind of move, the whole point of studying charts is to understand what a market has done, so you have a better picture of what a market can do. At the right edge of this chart, this is a bull flag. This is a bull flag with good pressure against that previous resistance. You would be absolutely correct over a large sample size in thinking long here. However, you would have been very wrong in this one particular situation. And so you almost certainly would have been stopped out. So you need to see, here's another example of a bull flag failing by strong momentum against. However, you also need to see that the fact that that bull flag fails does not mean the market's going to collapse. There definitely is that sense in a trader's mind that if you have a bullish pattern that fails, maybe the market is going to sell off very, very strongly. And it does happen, but many times you just get enough of a shock to shake you out of the long trade, and then there's not a satisfying trade to the downside. Some other patterns here to look at, but just notice again, all of the slide along the band's trends. And it turned out in this case, you could have bought some pullbacks from those, but I will tell you, if you are going to trade pullbacks, in my opinion, if you're going to trade pullbacks from slide along the band's trends, I would wait for something like this. I would wait for a nested pullback. So what that means is you have your market that's trending, and then you have your pullback. This is a difficult structure in a slide along the band's trend because sometimes you get this, right? And we don't want to get caught in that. So what you wait for is for the market to begin to move in that direction and then to have some little pause. This is really the spot where you can look to enter a slide along the band's trend. It's still difficult because there's still downside risk, and you will not always get those. Look here. Here you have another little jiggle around the slide along the band's trend, and you don't really get the nice positioning spot that you did here. If you go back here, sometimes you will find yourself buying much higher than you would usually be comfortable buying. But this is a pattern that is worth thinking about. Also worth pointing out here, this is a good example of a market that's not trending, at least in my opinion, and this is following that shock that we talked about. However, we do then get pressure against this, and one of the key concepts is that ranges are often continuation patterns. So this market was, if we're going to highlight the swing structure, I think we would look at something like this, right? So you can see we do have and there's really no swing here, I guess, but we do have a pattern of higher lows up against that resistance. That's how resistance typically breaks out. This is very typical trending action in a mature trend to then, once you get into the trend, once you have this bigger picture breakout, and this is like, I don't know what, 4 months of market action, then we do have some pretty sharp spikes against the trend there. Then something happened in 2020, do you remember? So here's the COVID stress. Here's the COVID bear market. This is an extreme situation. So one of the challenges when you're studying market action is you might think that you want to study what happens normally, right? That is, in fact, what we want to understand. We want to be able to look at something and say what usually happens in this situation. However, the extremes are also very, very important. And you could in some sense say that, like, if you really wanted to tell the story of the market, it's almost really the story of those extremes. So don't discount something like the COVID crash or the 9/11 stoppage or 1987. These big moves from history are very, very important to understand, if for no other reason than understanding what a market is capable of. But I think there's more. So this was in your system. and by system, I mean your framework, the way you think about markets has to be able to catch something like this. And notice here that even in this extreme situation, we had a little bit of a standard pullback. This was tradable, absolutely was tradable. And then look what happens when we get down near these lows. Look at all of these lower wicks. So this was, many of you lived through this market action with me. You remember it was like the world was burning, right? We were seeing literally unprecedented volatility in these markets, crazy, crazy, crazy moves on a daily basis. And at that point in time, was it conceivable that the stock market would lose 60% of its value, or perhaps even more? I think it was. My thinking at the time certainly was that we might have a lot more downside here. However, this action accumulating here in mid to late March, and I did not say that word lightly, this is evidence of accumulation. This was showing us, this was the first clue that something was wrong with the bear case. You should not see this very consistent pattern of wicks. Now, let's go back for a moment because I pointed this out here. Sorry, I pointed this out here where this is kind of the same thing, right? Where you have at this point on this chart, I don't think this is extremely bearish. And then these buyers lose and it becomes extremely bearish. So what I'm pointing out here is that in this COVID situation, this was extreme. Everything in an extreme market environment becomes extreme to the 10th, 100th, whatever power. Like we were just ridiculous extremes. So we were seeing things that we had never seen before, and having these 2 weeks of crazy, crazy, crazy lows, where you had these daily candles off of these lows. This in any normal environment would have told us don't think very much about shorts. And it turned out that was actually the argument here, that argument was correct here. However, if you were slow to get that message, I don't think that was a mistake. I think expecting something like that chart that I paged back to, where like, who knows at this point, maybe the market will collapse so much the next day that then they'll have to shut it down for a week until things stabilize. We were in that kind of crazy environment where that was possible. So it made you needed to be aware of this information, even if you chose to trade against it. However, look what happens. Eventually, we get a big buying candle. Now, just look at the recent data. It's not like we had not seen that before. So this is also one of the functions of downtrends, or one of the things that happens in downtrends is we will have some like eye-watering spikes against the downtrend. That is normal. However, they should be relatively short-lived. What you should not see is upside follow-through. And then look, what did you have? You had a couple days of upside follow-through. And then what did you have? You had stabilization. So folks, this is really important. I hope I'm communicating this well. So look at the stages here. You have all of these tails accumulating. You have a single day spike. Maybe no big deal so far, right? And then you have a little bit of upside continuation for that spike. Okay, that's starting to be a bigger deal. And then you have this stabilization. You don't, if you're short, you get kicked in the face here, right? That's 4. You don't have any downside off of this consolidation. Now the case for the bears is starting to look very, very weak. Is it possible? Let's say you're right here, right where I drew 4. Is it possible we're going to go right back to those highs? Doesn't seem very likely, right? So, I think aggressively buying here and closing your eyes and hoping for the best at the spot where I've drawn 4 does not really make sense. But it also does not make sense to be aggressively short. And if you had to pick a direction here at where I've drawn 4, long or short, you got to be biased to the upside. And then here for the bears, here's the coup de grace right here, 5. When you get this upside spike and then a little bit of follow through, it's over for the bears. And this, in retrospect, thinking about how I traded through this, what I'm outlining here is very similar to my thought process. Frankly, we crushed this pullback. Very, very good. Ripped up a little bit of money trying to short in this area, and then very clearly got the message that we should be on the long side here. Now, was it predictable that we would then just rip to the upside back to the highs? I don't think so, but you can see here, it at least was predictable to not lean very heavily on the downtrend. Is this subtle? Yes, I think it's subtle. Are you going to capture this with an indicator? I don't think so. I think you could construct an indicator to capture the factors that I have outlined. I think, however, your indicator with false positive all the time. Is this reproducible? Yes, absolutely. So this is a framework that I think you have to make it your own. You have to internalize it. Don't think like Adam. Don't be like Adam. Don't try to be a carbon copy of Adam. You got to be you. You got to figure out how to make this your own, how to create your own creed, how to create your own manifesto or whatever. You have to own this, but these tools are real and valid and repeatable. And there's something else very interesting going on here. So thinking about time, the Greeks wrote about 2 different kinds of time, chronos and kairos. And chronos is the time that I'm watching tick away here on my clock. It's always the same. It's quantitative. Kairos was an idea that, and this has survived in some modern religious thinking uses kairos in a very limited way, but the Greeks had a broad application for it that was basically the right time to do something. There's a tide in the affairs of men. That line refers to kairos. The line from the play where this was it Euripides, I think, was about the precise time that you would release a bowstring to hit a target. From a practical perspective, market time for traders is kairos time. What I mean is that, and for those of you who have day traded, you know the sensation, right? Where you're sitting in front of a screen and the whole day goes by and you think it's 10 o'clock in the morning and it's actually 3 o'clock in the afternoon because the market was so active that you just got completely in the flow. Yes, there's a relation to the flow experience here. There are also times where, like, you look at the clock and you're like, fucking 11 o'clock, like what? It seems like 3 days have gone by. What you can do when the volatility becomes extreme, when you're in these kind of, let's say you're a trader who only trades on the daily chart. Well, you might be putting on trades here back before COVID hit, and let's say maybe you were risking 50 S&P, I'm just making up a number, 50 S&P points to put on a trade. When this volatility expands, all of a sudden, you might need to risk 250 points for your stop. It's quite a lot, right? One of the ways you can do this, of course, you can just reduce your position size, or when the market becomes very active, you have to make sure this is not a break of discipline, but you can zoom in and look at a lower time frame. This is that COVID crash on a 2-hour chart. And what you see here is, a lot of structure. You see all of these tradable pullbacks, market locking limits sometimes. You see all of these ABCD swings, and then you can see, look what happens down here. frankly, this is something I missed at the time. So in my post-game analysis, and it's always, you want to be careful with that post-game analysis because a lot of people like to do trade review. A lot of people like to go back, and I do think it's important to do this to say, what did I miss? What should I have seen differently? You have to be careful that you're not resulting. And there I would refer you to that Annie Duke book, which is absolutely a book that you should read and should own in your mental space. I used to spend a lot of time with her in that book, and the message of evaluating your process based on your outcome, that's a perilous path to walk. But there still is, when you have a little bit more experience, I think it's easier to do. That's the dirty part about trade review is you're a beginning trader, you don't know what you're really evaluating, and arguably as you become more experienced and you might need it a little bit less, you're better equipped to do it. So I guess that's an argument for having some coaching too, maybe, I don't know. But one of the things that I think I missed that is pretty clear here is that just look here. Actually, no, that's too far ahead. Look here. So I think there is a lack of integrity, a lack of trend integrity that was visible here. Like you can see it on this chart, but you can really see it here. You can see the shift from all of these nice little consolidation patterns to all of a sudden, it's just like every day is a bad hair day, right? Like every day the market's just up and down. And what this shows is that nobody is in control. And when nobody is in control, even if the city is burning and it seems like the end of the world, but if nobody is in control, the bears are not in control. And if nobody is in control, that is a kind of equilibrium. Now, again, you have to step back a little bit and say, this is not a point where anybody's going to be making like very tight, high conviction trades. So it's normal for the market to be a little loose. It's normal for the volatility to be a little bit crazy, but this was a shift in market character that I got the memo, but I got the memo maybe 2 weeks later than I wished I had gotten it. It's better than not getting it at all, right? It's better than I have a buddy who shorted into the rest of 2020 and he no longer trades because this is what happened next. So let's dig into the 2020 bull market. I don't think we need to spend quite so much time here because if you look at this is pretty standard stuff. Let me flip back just so you can kind of see the interface. So look here, this low is now at the very left of your screen. So here's this consolidation we were talking about where I finally got the memo. I mean, okay, in retrospect, it wasn't that late, was it? But then kind of an interesting thing happens. So one of the things that happens in a very strong trend is the market gets ahead of itself. That's one of the ways to put it. So the market reaches these little points of climax, and the reactions from those, if you don't know what is happening, look at this. That doesn't look good, right? Look at this. If you're bullish, that does not look good. And in fact, here we actually have a successful short trade. So if you're keeping score, and you should be every fucking moment in the market, you should be keeping score. That's what we're doing, right? We're evaluating the buyers and sellers, like, who's feeling good about themselves. And if the bears can get a good ABCD trade in, then they're probably feeling pretty good about themselves. However, I would observe their measured move objective was there. I fell a little short at that, right? And then what happened here? We don't really spend much time below there. And then, oh, what's this? It's a little bit of developing price rejection around that, right? But then none of this is easy because we don't quite get back up to that high, and we end up spending a little bit of time ranging. So this is this is what happens when a trend gets ahead of itself. You'll reach these points of climax, and you want to be careful. Look, my very first trade ever, was, I believe, unless I'm recreating history, I bought wheat at a point that looked just about like that, except it was wheat, not stock market, so it ended up trending down like that. These are, as beginning traders, where do you finally feel safe, right? So, you know, maybe you didn't like this, maybe you didn't like this. This is still pretty scary. This is still pretty scary. Oh, look at this. This finally feels safe, so I'll buy there. This is natural. This is normal. If you haven't done this, you probably haven't been trading. But this is, once you understand that this is the rhythm of the market, once everybody starts to feel some consensus, once everybody starts to feel safe in this case, the market will then roll over into a multi-month sideways thing. Happens here, happens here. This is not really the same thing. This is just a false breakout. And then look here, this trend from here has a slightly different character. So a little bit more controlled. Let's look what happens here into the 2021 top. So this is just to orient. I kind of rolled past this, but look at this, that line is now the left of the chart. So you can see this trend did continue. We did have, more and more of this kind of confusion. A lot of nasty spikes against the trend. Again, you need to know markets do this. And look at this. Here's a ABC trade to the downside through the measured move objective here and here. Look here. What do you see? That is the same thing. Let me page back a little bit. It's another variation of this business, right? Now, is this a pattern that you could put in a book and say buy when you have this? So this is the issue with patterns. If we were writing a book on candlesticks, would you say, what if you have 4 candles with higher lows and each having a lower tail that was at least 1/3 of the body with a close on the last candle? Like, you could make this a pattern, but it's not about that. It's not about the pattern. It's about what the candles, what the bars, what the trading session reveals in the conviction of the buyers and sellers. And this was a message that I can tell you I did get right there in real time. Once you start to see this, then you're prepared to act aggressively on this consolidation. Not every pullback happens up at the upper Keltner channels. This is this near the moving average off of this low, pretty good signal. Slide along the bands, a little overextension, and then we get nasty, right? This is nasty. But we've had this before, right? We've had this, we've had this, we've had this. Is this any different than that? I don't really think so. You do have, what might you notice? Well, you might notice we really can't hold above that. So this is sort of the flip side of this argument, right? On a slightly different time frame. However, the downside is not really impressive. And then we consolidate. This is beautiful. We consolidate. We finally do break out on really good momentum. We consolidate above that high. This is a picture perfect setup for a long trade. Not to be. So this is why you need to know good patterns. What you need to know the expected outcome of patterns. You need to see that this little consolidation above this previous breakout level, and it's not really a level, right? It's a zone. It's kind of like all of this was a potential resistance level that we did break above. This had a strong expectation of breaking out to the upside. So you were able to identify on this day, shit got real when we're back in that range. And we'll talk about breakouts more later. But if you did not get the message then this failure to break out of the high the second time gave you strong motivation to think about the downside. Now, this is beginning of 2022, and this is now at the left side of your chart. Is this a trend? 2022 was a pretty difficult trading environment, and one of the things that I would point out here, well, look at this for a moment. Answer the question: what trends do you see here? And there's really no right or wrong. There are rights and wrongs based on your particular definition. So if you have a uh, very short-term definition of trend, you might call that an uptrend. You might call the whole thing a downtrend. You might call the whole thing a downwardly biased trading range, but you do need to be consistent. This is a question you need to answer for yourself in your analytical framework. How would you define this trend? One of the ways I would think about it is to, even if I am not going to trade pullbacks, and I don't know that I've marked every possible pullback trade here, but just look how many times, we'll go back and look at a better trending environment too. How many times, if I was thinking about, so there's a pullback trade, I'm looking to short, that one works. Here I'm looking to buy this pullback, and we have a like type 1 success, but really we don't really get anywhere. Here I'm looking to short, that one works. Here I'm looking to short, we don't get to that previous level. Here I'm looking to buy, it's not a great pullback. Here I'm looking to buy, it doesn't work. Point is, many of these trades fail. And if you go back and look at a clean trending environment, most of the pullbacks succeed. So that is, now granted, it's an after the fact evaluation, but you also can see in real time that, first of all, like if you're in this area, you will see, well, we're not getting really great pullbacks and we're not getting really great follow through, because I know we just came from a loss here, and I know that this short didn't work out. So things aren't really working out very well. And then, like if you're here, like, okay, that's kind of a weird spike, and maybe that should have continued to the upside, but now, so you see the character of the market has changed, and you have all of these false signals, all of these things that don't work out. And in this type of environment, nothing is really going to help you. If you try I drew swings, this isn't really going to help you. This is not a very the same tools that would have served you very well through this kind of environment or this kind of environment will not work very well here. So you need to be prepared that, how do you manage this? How do you, and there are a lot of different answers, one of which is to have different ways to trade that you try to match the market environment. But one of the other ways is simply to reduce your exposure, or to reduce your profit targets, where, if you see that you're in a suboptimal trading environment, maybe you look to take full profits at that first profit target for your pullbacks. Maybe you require slightly different things to get you in and out of a trade. But just to point out that I don't really think there's any reliable way to structure this environment. Of course, here's a more trending environment. You can see the swings are beautiful, but it's a reflection of what's going on in the market, and there's no magic that's going to guide you through this. So let's take a little bit of a break there, and then we'll come back and do some more, and I will also get to your questions. So if that generated some questions, drop your questions in the question box and we'll get to those. Okay, here we go. Welcome back. I hope I'm back. So I do think that it's worth nailing down how you want to see these, how you want to think about these. And everything we're talking about so far is theoretical. We're going to turn our attention here in a few sessions to practical trading, to what you actually do with this information. But it's important for you to both define what you're doing and to also like kind of break out of that, try to look at things in different ways, to try to see how uh, and this is one reason why I have studied so many different kinds of trading and read so many different authors, and many of whom I disagree with profoundly. You still will learn something, and you can take something away, if nothing else, what you don't want to do. So just to kind of bring all of this back, we've looked at some specifics. Let's look at generals now. So the general concepts, how do trends begin? So we have seen examples here, and you can go back and look at the slides, and you will see examples where trends begin with sharp momentum or with momentum slowly developing. You will also see examples where trends begin with or without a clear breakout. Why am I emphasizing this? Because you will find many analytical structures will tell you that trends always begin with sharp momentum. Trends always begin with a breakout. And we just looked at several years of S&P data, and you can disprove that. Of course, you have to be careful with the word always in general, right? You will see that sometimes trends begin just from a trend in the opposite direction. Maybe a market that's downtrending and now it's uptrending, or you will have markets where it's trending or it's ranging and then the trend begins from a range. All of these are possible. So you have to open your mind to all of the different ways these patterns can develop. How do trends continue? At the same rate of trend, the rate of trend can accelerate, or the rate of trend can decelerate. So practically speaking, if you're looking at a slope on a chart, you have a market that's trending like this, and it can then do this, or it can then do this. And when you get this does not necessarily mean, a lot of people will say when the momentum starts to subside, a lot of people say that means the trend is going to end. It does not necessarily mean that. You can go back and look at the charts that I've given you and see many examples where that is not the case. Volatility can increase or decrease or stay the same in a trend. Trends can include, and in fact frequently do include, strong shocks in the direction of the trend. So you have a market that maybe does something like this. But you also can have a market that just kind of slides. We talked about the slide along the bands trend. One of the things that is very important is that pullbacks and consolidations in a trend will work more often than they don't. Now, it does not necessarily mean that failed pullbacks show that the trend is going to end, but what you should not see in a good trend is a lot of pullbacks that fail. If you do start to see that, you start to see a failure of momentum in the trend direction, failure of conviction. We're not going to spend a lot of time on endings today. As I said, we'll really push that to the session on where we're looking at the interface between trends and ranges. Trends do usually end with a clear failure. Sometimes there can be sharp momentum against, or you can just start to see support and resistance holding against the trend, or sometimes a climax. And there are a lot of ways, you can say, well, when a trend ends, a range begins, and you can definitely go down a rabbit hole with that. But it's enough to just say that if I've had this, think from a very practical perspective. I've had a market that is trending to the upside, and I've been able to buy for more upside when those trades are no longer going to work. That's what I would suggest. That's what we're looking for as being the end of a trend. Climax is really the thorniest one here if we're looking at these end of trend patterns, because there's kind of like a Goldilocks zone, where what a climax is the market makes a move that's, quote, too fast in the direction of the trend. And this typically occurs when it's a sign of consensus. It is one of the signs of an end of trend. And now, oh, you should be able to answer this now. The idea here is that consensus is bad. Why? Think about that. Goes back to what I said at the beginning of the presentation, that the only thing that can move markets is people changing camps. And if you had a market where literally everybody in the market who could possibly be in the market was long, everybody is bullish, what can happen? Only bad things, only selling, right? So that's obviously a crazy extreme that can't happen, but it's very useful to like, extrapolate these things to the limit and understand at the extremes what would happen. After these climaxes, and you've seen many examples, particularly that COVID low is a very good example. What happens after the climax will really tell you a lot more than the actual pattern itself. Now, I'm going to flip through these. What I've done in most cases, these are, so the idea is that what comes to the right is the trend. So, and I know, like, immediately if I see this, I'm tending to evaluate the middle of the chart, but no, what I'm showing you is like to the right of the chart in this first case is an uptrend. To the right of the second one is a downtrend. So I've just gone through, most of these are the S&P, some of them are crude oil that we didn't look at. And I've just snipped some of the beginnings of trends. So you can see the variety, right? You can see in this case, here is a trend that sort of slowly picks up momentum. Here's a trend that begins with a sharp downside shock. Here's a trend that begins with a sharp upside shock after a bottom. You see, right? In some cases, they just begin with momentum. Here's one that begins with some complicated structure. Now, what I would suggest you do is do this yourself. So the best book that you can write on trading, the best book that you can have on trading is the one that you write for yourself. So what I've done here, just simply going back through the beginnings of trends, yes, this is all like after the fact analysis, because what I'm doing is I'm looking at the market trends and I'm saying, okay, what happened at the beginning of that, right? So it's, this is not quantitative, but this is a valid way. If you do this over a large sample size, I've given you like 8 patterns here. You probably should have a few hundred. Do this yourself. Clip these examples of beginnings of trends. One idea that you might want to, I thought about perhaps you could flip them. So, they would all be uptrends or they would all be downtrends, or maybe you could have the patterns and have them all be uptrends and then, flip them so they're all downtrends, the same patterns. You would run into problems if you thought that there were, actually you'd run into problems with, you also should flip the candle polarity, which I guess ignore that, then it's a very bad idea. I've been talking for like 3 hours straight, so who knows. And then I've also marked the some endings of trends. So what I'm showing here, here's an uptrend that ends with a sudden shock against. Here's an uptrend that ends with resistance holding against, and then here's an uptrend that ends with a little bit of a double top, and here's a downtrend that ends with a spike. I think you get the point. Now I've marked these as true endings. I'll just kind of page through these here. You will have the slides. You can definitely go through the slides. Here is a true ending by climax. Here's another one by climax. Here's a single bar tail climax. There are also, of course, false endings, or places where the trend rolled over those endings, and that's what I've distinguished here. This is a pretty nice example right here. So classic bull flag that looks really nice, and then little inside bar consolidation, break to the downside. And here's kind of the cue sad trombones. Here's just a sort of rollover trend. Not every trend ends, we think that a trend ends with, and if we put in our in our books, we always are picturing some kind of like dramatic ending like these, but let's be aware that this kind of like just total failure into sideways certainly is a possibility. So if you want to trade trends, the essence of trend trading is trading pullbacks or perhaps breakouts. And this way it's very important to understand the price dynamics behind these patterns. Generally speaking, so if you want to trade breakouts, what you'd be doing with breakouts is you would be looking to buy here because you're trading the breakout of this, right? And you'd also be looking to buy here. The problem with this is that if you're trading only breakouts, it exposes you to potential mean reversion. And the other thing that trading only breakouts would do is some set of your trades get you long here, or it would get you short somewhere in here. Yeah, maybe not these exact examples, but you're going to find yourself on some percentage of these trades, you're getting the shittiest possible trade because the trade location, because you're getting the absolute extreme of a trend. So you do need to be aware of that. This is why I will tend to gravitate toward pullbacks, and we've seen lots of pullbacks. So this makes sense now, I hope, in a way it might not have made sense at the beginning. I might have thought this should have gone at the beginning. I did it deliberately this way. Pullbacks can be either consolidations. You can think of them as lower time frame trends. That was the example where you had an uptrend and then you had a pullback that was actually a downtrend within that context. The pullbacks resolving in the direction of the trend. When I use the word trend, the phrase trend integrity, that's what I mean. It means pullbacks are generally working. Understanding how these pullbacks are working can tell us a lot about the health of the trend, about the relative conviction of buyers and sellers, and not for nothing, these are great structures that can provide us with precise entry points and exit points. Just to look at these, we've seen many, but here are more. These are markets that we have not covered. I just wanted to show you lots and lots of examples. So here are pullbacks. These are pullbacks. This is let me highlight this specifically. This is what I would call a nested pullback. This is a small pullback. This is not really much of a pullback. This is more of a breakout trade. Pullback, pullback. Here's a pullback. Notice this would have been quite difficult to trade. You had the false breakout here, and then you had a false breakout to the upside. Notice what happens here. So pullback, but then so you get the message at some point that the trend is over. Also, this is a pullback. This is a pullback which reaches pretty close to a measured move objective, probably a little bit beyond. Pullback to the upside. And then look here, if you were trading a pullback here, this pullback fails, right? That's one of the pullback failures. So the best pullbacks come relatively early in the trend. They come after good momentum or impulse. And here's the subjectivity. It is a reluctant move. Now, you've seen, I don't know how many examples today, but this characterizing the move as a reluctant move is very, very useful. It's maybe the key thing you should ask yourself when you see a pullback to separate a pullback from a sharp reversal in the other direction. You can also think about the retracement percentage. We'll look at that in a moment. And you also want to see not many small patterns showing conviction against the trend. So what I mean is, this was specifically talk about location and trend, but I think that's obvious. But what you don't want to see, if you're looking to trade short through here, what you don't want to see are a lot of very sharp rejections from lows. This is not a sharp rejection from a low. It is a small reversal, but look how small these candles are compared to the setup candle. There are some tails here, but they're minuscule. They're not real. This is an upside candle. No real continuation though. Here you have a couple bars upside follow through, and here, this is, I pointed out, this would have been a difficult spot to trade. Let me erase everything but there. So you're looking, sorry, it's dumb. You're looking at this particular candle. That's really the first significant buying we've seen. It did also happen overnight. And in this case, it got rolled over. But then look what happens here. At the actual low, you do have a sharp reversal complex off of the low. Then you have a lower tail, and then you have a big up bar. This is the first bar. Look at this. You don't see that kind of up bar anywhere in this downtrend. So, for the people who say you can't time the market, I don't know, you tell me. Like, is that a break of pattern? It absolutely is. And this is something repeatable that you can do all the time. Retracement percentage. So what we're looking at with retracement percentage is, yes, I deliberately picked an ugly chart. This should hurt, right? What you're looking at is you want to see, let me make the chart a little bit bigger. You want to see, so you're looking at this move, right? You're looking at the size of this move, and then you want to see that the pullback holds. If it's going to be a good pullback, and it's not, there's nothing on this chart that's like really looks nice, but you don't want to see it go much beyond 50%. That's my personal measure. Another example here. So let's take that to here, and then we want to see that this pullback would hold around the 50% level. And if you are able to significantly go through that 50% level, it starts to look not so much like a pullback. Why not Fibonacci? So somebody asked, let me read back here. We had a couple questions. Mark said several hours ago, I'm sorry, if one believes in measured moves, well, first of all, one doesn't believe in measured moves. Like you can quantify them, you can see them, you can measure them. This is not a belief thing, okay? I want to be clear about that. This is based on what you can pull out of the market over a large sample size. Shouldn't one also believe in Fibonacci retracements and extensions, given the underlying concept of being based on present volatility is the same? So the issue, Mark, is that Fibonacci is based on saying that these very precise ratios, 38.2, 61.8, and to be fair, Fibonacci traders don't think that it has to respect it to the ultimate decimal place. They know the market has a little bit of noise, but they'll do things like they'll put an order to buy at a 38% retracement, and then they will put a stop at a 62% retracement or something like that. Fibonacci traders also use 50, which is bizarre because if you're a Fibonacci trader, because it's not at all a Fibonacci number. But the reason that, and I looked very hard to find this beautiful example in Apple for the book, where they do work to the tick, because if you start to look at a lot of retracements, so what I've done here is looked at 50,000 retracements, and I have looked at, so you have your setup leg, and then you have your retracement. So what I have looked at is measuring this retracement as a percentage of the setup leg. So yes, there's a lot of different ways to use Fibonacci, and people, we can do whataboutisms all day here. This is the problem of having a discussion with somebody who, quote, believes in this, that you can always say, did you measure confluence? Did you use this indicator with it? Did you use it in only this specific example? But many of the specific examples that those people will use, by the way, are carefully cherry picked. So they'll say, are you only measuring in an uptrend? Well, we just spent several hours understanding how to measure an uptrend, and that's pretty important. But if you look at a large, and I've done this many ways, again, this is not intended to be exhaustive. This is just to illustrate the point. This is where retracements terminate. The mean retracement level across a very large sample size is a little bit more than 60%, with a huge standard deviation of 20%. So what this tells me is, as a rough rule of thumb, if I'm depending, and you might say, wait, like, no, wait, that's 63%, like that's pretty close to a Fibonacci number. It's pretty close to a Fibonacci number. It's also pretty close to 50. It's pretty close to 75. Like, the degree of noise here is extreme. So from a practical standpoint, what I would look to do is anytime we start a pullback, I want to refer to the roughly 50% level, but I know that there's a big zone. I know that good retracements will come anywhere within this, like, 25 to 75% or even more. The reason that I don't use Fibonacci is because I can't pull it out of the data. And I have a number of blog posts on this, which we'll link in the playback. The work is also published in that second book. Again, maybe I have missed something, but I cannot try as I might. I can't find any reliable data that shows that Fibonacci is significant in the market. And I also, as I said, maybe very critically in a previous presentation, the people who lean on Fibonacci do not do quantitative work. It's a purely subjective looking at a chart. Can't you tell it works approach. And as we have seen from the trend indicators, you really can't just trust your subjective sense. You can't tell that it works. One of the other things, as long as we're killing sacred cows here, one of the other things that people will tell you is if you have two identical moves in the market and one has a shallow pullback and the other has a deeper pullback, what people will tell you, and this is perfectly logical and also wrong, one of the things they will tell you is that this first case has an expectation for a much bigger move than the second one. And the idea, of course, is that the buyers there's all kinds of logic here, right? Buyers stepped in sooner. This shows the buyers are stronger. However, what I have done here on this table is, and again, I've done this many different ways. This is just one illustration. This is looking at so there are three legs under consideration here. There is the setup leg, which I'll label S. There is the retracement leg, and there is the extension leg. So what I am measuring here is in this mean column. I'm measuring the size of the extension leg relative to the setup leg. So, and these are whole number percents. So 130% means that on average, the extension leg was 130% of the setup leg. And of course, you can see also the standard deviation is kind of mind-boggling, right? That's huge. And what I have done in each of these rows is I've categorized it by retracement length. So retracement less than 25, that would be a retracement that looks like that. The retracement's less than 25 of the setup leg. Retracement 50 to 75, that would be a retracement that looks like that. And retracement that's 75 to 100%, 100% retracement actually would get back all of that setup leg. And what you can see is, now keep in mind, this extension is measured based on the setup leg, not the retracement. It has nothing to do with the retracement. Is it true that the extension is bigger for a shallower retracement? Well, no, it's not. It's not at all true. So now there might be times that you might see a very small pullback, and you might think that that's all you get in a very explosive move because you're assessing the character of the market. That makes sense. But in general, this idea that shallower retracements lead to bigger moves is not just misleading, it's actually false. I would say that you can also see, based on the increasing standard deviations, there's clearly something going on with volatility here, and these numbers are so buried in the variability. I don't think, is it fair to say that deeper pullbacks actually lead to bigger extensions? I wouldn't say that either. I would simply say there's no real connection there. Three common pullback failures. So one is it fails into a flat range. So you have a market, and you've seen these in action. Now we're going to talk about them. So you have a market that then maybe it tries to go somewhere and it just doesn't. It just fizzles into a range. Failure number two is you have your pullback and maybe it begins and then it fails with very strong momentum against. And then failure number 3 is perhaps, by our definition, not even really a failure because you did get back to this previous pivot, but it's certainly a failure to continue the trend. That's why I would list it as a failure. If you do trade pullbacks, this is why you need to be vigilant. Not necessarily execute, but you need to be vigilant around those previous swings, and you will see very, very poor follow through. Just a few, poor follow through would be a warning of trend failure. Just a few examples here of pullback failures. You've seen many, but just to kind of wrap it up, here is a pullback failure around the previous low. No real conviction there. Here's a pullback failure by strong momentum against. Some of these are more manageable than others. One of the things that I'm the kind of trader who I like to get into trades. Where's an example here I can use? Okay, let's just say that I'm shorting here. So, maybe I would enter a short here, and maybe my initial stop would be here, just to use examples. And then what I will try to do is pretty quickly, I will end up tightening the stop. So, I'm hoping in most cases not to take a loss that's as large as my initial risk. And I'm hoping to essentially never take a loss that is bigger than that initial risk. Though sometimes with some markets, you do have some gap risk, it does happen. But the case where you have the strong momentum against, that's one of those cases where you will have your full 1R loss sometimes, and there's nothing you can do about it. It just happens. But many of the others are very manageable, and if you trade these structures, and again, we're not really talking about specifics with trading yet, you do need to have some rules for how to manage those. So let's look at pullbacks, and we'll get to questions here next. Let's use NVIDIA. It's been very much in the news here for the past couple of weeks. And let's just look. What I'm showing you here are the small inset panel is an hourly chart. So you can see how the market opened. And in this case, this open was a huge gap up. This was the earnings. And I just want to point out some things here. You can look at these, and you should look at these charts carefully, but let's look at some pullbacks. So first of all, this is not a pullback. This is a reversal complex. So you have this big spike to the upside. Not everything in the market is a pullback. Not everything in the market is a trend. This is a non-trending market. There perhaps was a bit of a tradable pullback here. You might have tried to trade a short pullback here with poor success. You might have tried to trade a long pullback here without much success. Perhaps a little bit of a short pullback here. So point being here, on this first day, and this is normal, the stock had a gigantic gap up. And when you have that kind of move, then we're in those kind of price dynamics where big move up, big move down, even though there really wasn't a subsequent move down, but you have that shock. Many times what the market is trying to do is just to kind of like understand where it is, and you will tend, after those types of big gaps, a lot of times you'll have two-sided trading that result in very, very poor pullback trades. Whether you were trading them or not, you see they aren't working. You see that you're having very limited trend continuation here. Looking at pullbacks here, let's just, this is not necessarily the right tool to look at every day here, but let's use pullbacks as a structure. This is potentially climactic, so you're not looking for a pullback trade here. This is perhaps a breakout setup. Here, you might be looking for a pullback failure against. Here, you might be looking for a pullback. Still not a great environment, but you can see I deliberately chose an example that I knew would be challenging, because I don't want you to walk away from this and say, okay, all I have to do is find pullbacks and every trade is going to work out. This is an environment that does not favor pullbacks, even though I do want to point out also, this is a market that pretty clearly was uptrending. So even though you stood quite a bit higher at the end of the day than the beginning of the day, there were not necessarily tradable pullbacks. One of the things that you can notice, though, is that every downside shock was pretty quickly absorbed. So that is information, right? Even if they were not tradable, you did have many more consolidations resolving to the upside. Then we have here another gap up opening. This is not the whole day, just to be clear. This is where we opened. And look what happens here. Now you start to have bearish pullbacks that resolve with some degree of success to the downside. Real market data here. Here is another minor gap down back in the range. Now look. So there's also a bigger picture lesson here. If you were a pullback trader, this was a really rough day. This is a really bad day. Now it's a day that should not have been a big P&L day for you because it should have been very clear from the overall character of the day. This was not likely to be a very tradable day in pullback style. You might have had some minor losses here, but it's very easy to get frustrated with the market and then come back if you're a day trader, look at it 2 or 3 weeks later and realize that you missed, after a few frustrating days, you missed the good trading environments. This is psychologically one of the things that is challenging for traders, is if your methodology has taken some blows, if you've taken some losses, it's very easy to say, I'm just going to give it some time to cool off. And then what you can find yourself in is this nasty cycle where your times away are the times where it would have worked. And just to point out here, pullbacks resolving to the downside. Look, here's a pullback. Even if you don't trade these, I'm going to make the argument in a later session that these patterns taken all together are a complete analytical framework. So even if you don't trade them, noticing how these patterns are resolving will tell you a lot about market character. And then actually, I'm going to just kind of fast forward through these because I think you can do the work yourself. I wanted to put these here with that introduction. This is a relatively easier, and this is also a relatively easier section of market data. This set of charts will reward your time for careful study, looking at resolution of pullbacks, looking at shocks, and then looking at that as the lens through which to see overall trend integrity. Coming into questions and answers, guys. So a little bit of wrap up here. This idea about numbers to leave numbers, form to leave form. That's what we're doing with all of this. That's the point of spending hours and days of our lives peering deeply into this, is not so we have to analyze every little nuance, but so we have a framework and we have an understanding of what the market is doing. Definitions matter. You and I can define an uptrend and a downtrend in very different ways, and find the same section of market data could be defined as being something very different. However, your definitions matter only as far as they relate to your trading. So what I mean by that is, if let's say we have an area that I would define as a downtrend and you would define as an uptrend, I should be making short trades and you should be making long trades. Or, at least we could be avoiding the other side. But these definitions, if they're not going to be like academic, silly things that we don't ever really touch, they have to be things that shape our behavior. It's very hard to evaluate trading ideas, very hard to evaluate trading tools. You cannot trust your perception. You cannot trust your intuition. Even after you've done this for a long time, I have good intuition about some aspects of markets, but I know I have absolutely no valid intuition about whether a tool is valid or not. Patterns give us both executable trading points, also good clues to trend integrity. We've talked a lot about the patterns that begin and continue trends. Think a little bit about Kairos. I think that is this idea of time being flexible, being based on the psychology of having. It's also why time seems to accelerate as you get older, right? Why days seem so much longer when you were a kid, because you have more events to hang those pegs on. It's also I guess maybe the last takeaway here is it's a really good idea to understand pullbacks, and I think you should understand pullbacks. Okay, I have a few prepared questions here that people sent, and then I will go back through Betsy and Tom and Annie. Just drop whatever questions you think I need to get into chat. I'll go back through all of those questions that are there. Okay, so what about MACD divergence? I don't use that in any meaningful way. And in fact, I'm not really using the MACD in any meaningful way. And we will talk about this in a later session, but it's a tool that I find more misleading than useful. What to do or not to do after climax, I think we covered that. I can say very clearly what you don't want to do is to try to trade with the existing trend. So if you've had an uptrend and then what we call like a blow off top is one of the words people use, or a buying climax, a parabolic move to the upside and then a collapse. You don't want to be buying that. You at least want to be in the mode where you're not buying that decline, you're not buying that weakness. Maybe you can look to set up a short in the bound, and we looked at several possibilities for that, but at the very least you have to know that you're not going to trade with that existing trend because it's probably no longer existing. What do these mean? A pullback is usually a period of lower volatility and action. That was poorly phrased in the book. I apologize for that. But it's why I was referring to character, which I think we have covered and we have talked about in considerable detail in this presentation. But pullback usually has lower volatility. Usually the ranges will be smaller. The volume will be lower. It's also related to that, but what I meant by action there was the pullback will be what we're now calling reluctant. Lower time frame ranges should be smaller in most pullbacks, and there should not be as much conviction in taking liquidity from the book. The phrase conviction in taking liquidity, what does that mean? So that is a very short-term way of thinking about trading. So if you have bids and offers, if you're taking liquidity from the book, what that means is that I'm buying by taking the offer. And I will do that as a trader. I don't want to do that because I'm going to pay the bid-ask spread, and I would much rather buy on the bid. I'd much rather make that spread than have to pay it. And I also know if I do that in any meaningful size, if I take the offers, or conversely, the phrases to hit the bid, that I'll move the market, because people aren't going to sit there on the offer and say, oh, this guy wants to buy, well, maybe he'll buy higher. So it's not as good if I want to buy for me to pay the offer. So I will only do that if I think it has to be done right now. And that's what that means. Some orders will add liquidity to the book, that's joining the bid, or some orders will take liquidity from the book, and that's taking the offer, paying the offer. Conceptually, it refers to the psychology of either buying like right now or buying more patiently. It's a good question, thank you. So good subtle reading. Where is the trend here? So this is an example of a pullback that is not really set up by a trend. This is a range, whether you draw the range here or you might draw the range down here, it's fine, but this was a pullback following a sharp momentum move that might have resolved to the upside. So you're looking at this and saying, this is not really trending. You're correct, absolutely. Are we talking about two different consolidations here? It's, again, not a perfect wording. So at the point marked A, I'll just read it, the consolidation had failed. So the pattern was broken by two large candles under the bottom of the pattern with a close far underneath at A. So what I meant really was the confine, the geometric pattern we would have drawn around the consolidation had failed. In this case, I meant that support, that theoretical support, had failed to hold. So the first part means that this was looking like a breakdown. It was looking like a short entry. If you're an aggressive short, you might even have shorted that bar that is marked A. That was the intent in the book. But look carefully what happened next. There was no momentum and no selling conviction below that level. Within 2 days, the market was subtly back above the consolidation. So again, what I mean by the consolidation there is the market was back up above the confines of that consolidation and was back up above that line that I've highlighted in red. So before we jump into the questions in the chat, register for the next session, Saturday, 24th of June, again at 1 p.m. There's the registration link. You don't have to type in 8122488. I will tweet this. And also we'll send emails too. So we'll make sure that Tom, we actually should put this registration link in the follow-up email. That would be a smart thing that we've never done that we should do. But we'll cover trading ranges. We also will spend a lot of time in chapter 4 on understanding what happens around support and resistance. And we will spend a little bit more time looking at the character of individual bars. That's something that's touched on in the book, but we'll spend a little bit more time with it. Okay, I'm going to go back through the chat and get questions here. Last session, you talked about 4 types of trades, one of which was a trend termination, which includes but is not necessarily a reversal. Could you give an example of a trend termination trade that is not a reversal? Sure. So trend termination just means the trend ends and it might end into a trading range. That's all it means. So a trend reversal is markets uptrending. Boom, now we're downtrending. That's a trend reversal. But another possibility is the market's uptrending. Now we're no longer uptrending. We're just going sideways. We're in a trading range. That's all that means. Is there any way to distinguish between slide along the band's trends versus potential climax? So slide along the band's trend is not usually climactic. What I can tell you is if you have the slide along the band's trend and then it accelerates, that's very likely climactic. You definitely want to be extremely cautious about buying an upside break out of a slide along the band's trend. The problem with the slide along the band's trend is you don't want to short it either for the uptrend because it can just go and go and go. When you find yourself, when you find yourself fortunate enough to be long a slide along the band's trend or short you in the right direction, you can use a stop that's many times at either the previous day's low or maybe the lowest low of the last 2 or 3 days. That a very simple stop like that will keep you in those moves. Sometimes they will just go. I've been in trades like that, and it's kind of silly, but look, at some point you're just wanting to get stopped out because it does become a little bit of it's a little bit of a psychological stress. You're like, holy shit, the rubber band is like, how much further can this thing go? And when you ask that question, the answer is you don't know. Because who knows, maybe it will accelerate into a parabolic blow off. You kind of get to this point where like you just want to be stopped out so you can just take the profit on the trade. But and then of course gap risk is a little bit of a concern with some markets, but not a huge concern because I've definitely been in those trades where we gap under the you're in slide along the band's trend, goes parabolic, and then it gaps down, and you get what looks like a really crappy exit, but it's hugely profitable because big slide along the band's trend. So it's not necessarily climactic. We'll look more at climaxes in in future sessions. This is what happens after I've been talking for like 3 hours, time warps. Does this work in all time frames? Yeah, I mean, basically, so we talked about, maybe that was before we got into that, but this does scale. If fractals are not good prediction models, then I assume mathematics based on natural science, such as normal curve, bell curve, do not work as well either. Yeah, very few things in markets are normally distributed. And I mean that in the formal sense of the normal distribution. So yes, I think that is correct. Yet, trillions of dollars are still managed under risk management paradigms that I will tell you, I can relate this without without naming the guilty parties. I had the global risk manager for a major investment bank. You absolutely know the bank. When I challenged him on the risk management system they were using for their internal trades and for client trades, because my point was that these assumptions are really garbage. Out of frustration, he's like, you know what? Yes, you're right. And he said, if anybody ever knew their actual risk, nobody would ever place a trade. So a lot of this generates financial crises. Bad mathematical modeling, but the math is very tractable, I guess is maybe the word, but it's just unfortunately not really connected with reality. And again, you can read Mandelbrot for that. The Misbehavior of Markets is a good book where he talks about the issues with these distributions that probably the right distributions to use are pretty ugly mathematically. In my experience, are higher time frame expectations used for identifying lower time frame opportunities? Yes, to some extent. And and then he gives an example. If there's a measured move on the daily chart, would I look for a smaller pullback on a 15-minute chart? That's what makes the nested pullback work. If you can identify the point, so it's not necessarily a time frame nesting thing, but if you can identify a pullback where you're expecting a good move out of that pullback, which, let's acknowledge might not happen, but you have good reasons to expect a strong resolution of that pullback, then you can look for smaller consolidations on that time frame, or you could go down to a lower time frame, I suppose. So yes, that is certainly a valid concept. Baseline drift, we got that. Okay, I think. What I think about Hikinashi for trend indicator, not much. When calculating returns relative to baseline on live trading accounts, we can adjust for deposits and withdrawals in the account. Yeah, I mean that's accounting. Which it's kind of a different answer, but there's very solid math for that because this is obviously a problem that like hedge funds have all the time, deposits and redemptions. So yeah, you definitely need to. How do I feel about the DeMark indicators? I don't feel about them at all. All the testing I did on them, I really couldn't find any real edge. I mean, I don't use them. I could use them, right? I mean, that's the thing. Like my goal here with testing all of this stuff was to find stuff that I wanted to use. It wasn't to prove that stuff didn't work, but was not able to extract an edge there. If the confluence moving averages are consistently aligning traders on the wrong side, does that mean it is profitable if you do the opposite? I would say that it means that you are you would find yourself on the right side of the market more often. So potentially. I think the reality is that most of those numbers were so close to zero that they're just lost in the noise. I think that there's danger in using a tool that where you think you know something that you don't really know. I mean, imagine a pilot using an instrument that's disconnected from reality, right? Like an altimeter that tells you you're a random amount of feet above a mountain. It's not so useful. And this is what traders do with complete bliss because they don't know the tools don't work. So I think it's better, in my opinion, to not use something if there's no strong edge. Could the slide along the bands also classically be called channeling? I don't, if you talk about the classical use of that word, I don't really know what literature it would be referring to. That could be okay, but no, it's not really. No, it's not, because it's like the market just sits there on the bands, and you can only really see it on Keltners or Bollingers. It works a little bit better with Bollingers or Keltner. I'm sorry, works better with Keltners because Bollingers are unstable. Mid 2018, would it be valid to look at the entire chart as a trading range and possibly worried to be in any of the previous high? Yeah, I think so. And Mason, that's a reasonable interpretation. When it comes to pattern recognition and timing, do you think being a musician helps trading? I think maybe so in some ways, because we get very used to manipulating patterns. It's all patterns, and musical patterns are patterns that exist in time. And I'm thinking a lot recently about like some geometrical representations of time. I tried to tell somebody this who looked at me like I was like I had a third eye or something. I don't know. It made sense to me, but I do think that there are some things with the ways you can break patterns down into sub patterns. Only those patterns can be manipulated. And thinking about patterns as material, I think that there's probably something. I'd be interested if there's anything on the neuroscience level. Um, this is on pullbacks. Jim says, with the data presented, rather than looking at 50%, should we target 60% or just keep the 50% accept variance? I mean, to me, it's so noisy. 50% is kind of very easy visually. I and the reality is what you're not really like looking at that as a line in the sand, because it's really this zone from like 25 to 80 or something. And but what we're looking at more than that, or certainly as much as that, is the conviction within that level. So it's not just that we pulled back to touch that 50% level. It's that we should not see a lot of strong counter trend. We should not see a lot of rejections in the trend direction. That's really more important. Looking at the retracement percentage is probably the least important of those pieces. I'll look back on the weekly chart to find a star where the price remained about the same with long wicks to either side. So you're talking like a big doji, which I know is not really correct. And then use the level to inform where to place a pullback target. Is that crazy? That's not crazy. Have I tested tomorrow? We covered that. How much does daily volume influence my assessment of the strategy? Not at all. I never look at volume. In the chapter, I talk about short-term trend lines. Please discuss some of their applications. I don't really use them subjectively. I'm aware of them, but we've quantified them in some sense. But it's not something that's super important. Could you technically just use swing length? 50% retracement is a valid approach. System not use any other indicators. I think you could. For me, I find that it's really been a process of eliminating things, and I find that having some measure of extension from some kind of average price is important for me. I can't trade very well without it, so I do need on my chart some kind of average, some kind of band. If you don't need that, you don't need that. So could you be successful without it? I believe absolutely so. Do I believe a significant aspect of becoming a trader is dependent on implicit learning? Yeah, I think this is something I'm thinking about a lot lately. I've come up with some exercises to resurrected some old exercises and come up with some new to kind of structure this. I think that's part of it. I think part of it is self-awareness. I think a lot of it is alignment. I think even for a systematic trader, I think there's a big dose of implicit learning that goes into all of this. Last question here, I believe. What's the easiest way to scan for potential pullbacks? I don't think there really is an easy way. The way that we use, I have a algorithmic trading system that could trade pullbacks more or less successfully as a standalone, and I use its candidates as an input for my discretionary work. So I think this is one of the problems with there are all of these scanners out there, FinViz and a ton of others. There are a lot of good scanners, a lot of good sources of free information, but it's very, very difficult to create a robust and useful scanning methodology for pullbacks. I find even with our algorithmic tool, my discretionary input is very valuable. So I don't mean to be discouraging, but I would look at things like whatever you can quantify in terms of momentum, and then character the pullback, and it's not particularly easy to do. for people who don't have experience with coding, is there any software or program you recommend for back testing? So a little bit off topic there, but I think the key thing is really to understand the statistics that you're looking at, and you can do a lot of work in Excel, but it's very small mistakes can be very misleading. And like where I showed you with the offset of the day, if you were looking at a trend indicator that, just to review, if you're looking at a trend indicator and you say, okay, let's use closing above a moving average means we are in an uptrend. Closing below moving average means we're in a downtrend. And then what you're going to do is to take the percentage return for each day. If you take that day that closes above the moving average as an uptrend day, that's not the day it flips. If you take that one, your results will be totally wrong. And there are all kinds of little gotchas like that. At one point, I thought that it made sense to teach people to do this, but it's really to do this kind of coding, to do this kind of work, it's really a separate venture, and it's really quite difficult because you need to understand, it's not about learning a programming language. Programming is really about knowing how to structure problems, and then the choice of language you use is not so important. It's also equally important to understand the statistics, and then if you have that, you can actually do a lot of valid work in Excel. But probably Python would be my choice if I had to pick one. But again, that's, I think you're looking at, if you want to learn to trade, I think this is something that has changed in my thinking over the past few years, past decade. I don't think it makes sense to say you're going to become a programmer and figure out how to trade from them, because that's, it's going to be several years before you can really do anything there, and that's going to hold back your process of trading. So I know that's not really the best answer to end on, but just gives you some idea of the complexity involved. Okay, folks, thank you. Appreciate your focus, appreciate your time. And we get the urban soundtrack while we end here. Appreciate your time and attention, and I'll look forward to seeing you in the next session. Follow me on Twitter if you don't already. I will dump a lot of content there, and maybe I'll drip some of this presentation out there in little pieces too. Thank you. See you back next time.